in about a day's time, TK?
I just want to go back to it. I'm old school on this. I'm sorry. Everybody talks too much. You know,
Is that including us?
Yeah, I was about to say.
Everybody. There's too many speeches. Can we just get a rule where they can only speak once a week?
Is that for us or
Shall I
for
restart the show? Live from New York City this morning. Good morning. Good morning.
What? You know.
Does that help? Is that better? Just like stop talking?
No, I'm not talking about you. I'm talking about the Fed presidents and all the communication.
Well, they stop now, don't they? From tomorrow.
Yeah, which is good. They should stop all the time. You know, that's where I am.
All right, Bram, are you allowed to speak? It's okay.
Thank you. I appreciate that.
You've got Tom's permission this morning.
Okay, that's very exciting. I think it's a very hard message, and what we've been hearing from Fed officials has been pretty consistent, which is whether it's in a good place or not, there is some value to waiting. And that is a hard message for an impatient market to hear, because nobody wants to wait. We want to price in what's going to happen. What's going to happen? What are you thinking about?
Yeah.
And there is no answer. They want to wait to get a collection of data that they can then say that they're dependent on, and they can massage in a certain way, because ultimately the data is confusing right now. It is incredibly confusing and really painting some
We're in a good
contradictory
place.
messages.
I mean, I'm sorry. John Williams came out. McKee nailed it with that great conversation.
So Williams says we're in a good place. We're in a good place.
I do a panel. There's no cocktails. They break out the cocktails for McKee and Williams.
You had drinks last night.
Yeah, they had drinks, and so they got.
Did John have drinks last night?
John said we're in a good place.
Confirm.
You know,
Okay, we're in a good place. Let's talk about the labour market.
Yeah.
We're all anticipating the slowdown inflation. They use these words like rebalancing the labour market, a softer labour market, a weaker labour market. That's the objective of this Federal Reserve. So let's put two stories together. You've got this debate between a big union and the Detroit Three, GM, Ford, Stellantis. Still can't get used to saying Stellantis, but anyway, there we go. Doesn't make sense, but anyway, they're the Detroit Three right now. And you've got this debate ongoing, Lisa, where apparently 16% pay raise isn't enough for this union. So I'm trying to figure out whether these debates, these conversations, this tension between unions and the Detroit Three are the dying embers of a hot labour market, or maybe just another sign that this sticky inflation story, tight labour market, is going to stay with us. Which one is it?
Yes, you ask a different person, they're going to give you a different answer. There's both, and that's sort of the frustration right now, and giving some sort of blanket characterization. There clearly is a softening in the labor market. Did you see the story about Walmart quietly creating a new framework that lowered the pay effectively of starting workers?
Though,
it was super nuanced. They basically changed a framework to even out the starting salaries of different people. Either way, there are signs that they don't have to pay up in the same kind of way as they used to hire people. People are staying longer. They're not quitting as much. But in certain industries, there is a lock on the labor market, and that is what you're seeing, perhaps.
I'm glad you bring this up, because I think it's a bigger deal than we think. Are we going to have a auto strike at midnight, September 15th? And I just think it's, you know, it's not that it's under the radar. That's Friday next, a week from now.
How does the president respond to it? On a campaign trail.
He's going to respond to it
politically.
Again.
He said it a million times. He said it a million times. He's the most pro-union president in the history of this country. So surely the most pro-union president in the history of this country would support that strike. No?
He's going to take a middle ground because there's so much baggage with Detroit.
How can you reconcile taking a middle ground with that statement from this
president? It's not going to happen, John. That's what he said.
It's not going to happen?
Yeah.
He hopes it doesn't happen.
Exactly, because otherwise it does create a real issue.
Because then he should be out on the line with them, shouldn't he? As the most pro-union president in the history of this country. That's the auto manufacturers. Here on Wall Street, different story. Goldman, potentially, Tom, cutting the underperformers, according to the Financial Times. That could kickstart later next month.
But that's a calendar item. As Sonali Basak would say, that's what they do in September. That's what they do into October. They start lining up the underperformers. I'm going to call it 3% of staff. Maybe I'm wrong, plus or minus 1, but the bottom line is it's the time of year where you do that. I really wonder how unusual that is.
It's a difficult time of year. Equity futures on the S&P, if you are just tuning in, welcome. Negative here by 0.1%. Yield's just about unchanged on a 10-year lease of 424. Crude still in and around 90, 87.30 on WTI. And the euro, we've used this phrase all morning, clinging to 107. 107.03, that currency pair positive by almost 0.1%.
Today, very much geopolitics front and center, which is a really hard thing to know how to price around, but has been dominant this week. President Biden heading to New Delhi ahead of the G20 meetings He's got a bilateral meeting with Prime Minister Narendra Modi of India at 10:05 a.m., a real important meeting, especially in light of the tensions between the U.S. and China, and even China and India. Today, the last gasp of Fed speak includes Fed Vice Chair for Supervision Michael Barr at 9 a.m., San Francisco Fed President Mary Daly at 11 a.m., and the eco data is light, but we do get some sense of the household change in credit and the feeling that people have of wealth. We get household net worth at 12 noon and consumer credit at 3 p.m. at a time where credit delinquencies are picking up just a little bit, but really nothing to write home about. Really subdued levels relative to pre-pandemic, John.
Bramo, thank you. Joining us now is Amy Wu-Silverman, Head of Derivative Strategy over at RBC Capital Markets. Amy, let's start with volatility. That's your world. Why do you believe that volatility, and we have the ingredients for, a pickup in the VIX and vol?
Good morning, John. So, I think the last time we spoke, I said I was reluctant to be the strategist who cried low vol. And the reason for that is that we've just had option prices at decade-plus lows, and everyone knows that an issue is volatility can stay low for quite a long time. I think what's different now, and I think why we can catalyze higher volatility, is that there's just simply enough events happening. You guys mentioned the United Auto Workers strikes. There's going to be the debt ceiling. There's going to be CPI, just a slew of events coming up. But secondly, I think positioning has really changed, and you've seen that inflection in sentiment in the options market. And I think those two things can really catalyze low volatility from here.
Amy, something's changed here in your research note. You talk about the October skew that's out there, that there's a bet on the market. What is the size of the bet on the market right now? I can't get a handle. Are people legitimately gloomy and placing their bets gloomy or not?
Yeah, it's a great question, Tom. So I think the problem is the answer is a little bit nuanced. When we spoke a few months ago, front and center was the fact that there was so much mega cap tech exuberance. It was essentially overwhelming everything else. There was outsized call demand in NVIDIA and Apple in your Magnificent Seven. Essentially what has happened is a lot of that has waned. So you really, when you look at the call skew portion of the market in the Magnificent Seven and in NASDAQ overall, that bullish sentiment has really waned. And what that has done is it's really taken the tailwind out of the market. So that positive momentum begets momentum. Forced dealer buying, a lot of that has gone away, but we haven't actively seen that pickup in bearishness yet, although I do expect that could happen, especially with some of the recent news we've seen, but that hasn't actually happened yet.
So in other words, when it comes to the big tech giants, what we're seeing from Apple is also coming at a time where sentiment has been shifting, and further news that could catalyze the downside will be met with a sell-off in these tech names that's more significant than, say, a couple of weeks ago. Is that right?
Yeah, that's right. And, the other thing that I think is interesting, I was speaking with a client, and initially, when you look at the options market, Lisa, a lot of the fear has been concentrated in China and FXI, EEM, your related ETFs. And historically, that's actually been a flight to safety trade for mega cap tech. What I think is interesting this time around, you're not seeing that. So, perhaps this is very Apple specific news, but in the past few months, if things were not going well in China, a lot of that tech money from China would flood into the Magnificent Seven. You're not seeing that this time around, and you're seeing much more of the hit to long duration in general as we talk about the rate story.
What's the put bet right now on Apple? Just as one example. I mean, what's the weight of, what are adults doing on Apple here with an 8% stock pullback?
So when you look at the differential, Tom, between that call skew and the put skew, you see substantial waning in the call skew. So meaning a lot of that bullish sentiment, that air has been let out of the market, and you're starting to see that pick up in that put demand. So that isn't somewhere where I would say, hey, look, this is at historical all-time highs. We're not seeing that yet, but it's steadily climbing each day as this continues to be in the news of what China is doing with the ban and things like that.
Well, not to be rude on Friday, but I got to make some money. Does Amy Wu-Silverman load the boat this morning on Apple because the skew's gone negative?
So one thing we've been talking about closely as well with Lori Cavacina, our head of equity strategy, is are we going to see that rotation now from growth into value? Is this the time where that really catalyzes? If that is the case, what I would say is a lot of your volatility across the board has still remained quite attractive. So you can play that in either two ways. You can use that to catalyze long volatility hedges in your mega cap tech, or you can use it to be long something like volatility in IWM through calls.
Amy, thanks for the update. Amy, Will Silverman there of RBC. You want an update on one of the biggest bears on Wall Street? No longer the biggest bear on Wall Street. Greg Bowdle of BNP Paribas, 3,400. He brings that price target higher, Tom, to 41.50 on the S&P. The bear capitulates over at BNP.
The bear capitulates, but he resets a little south of where we are right now. So, you know, and these are all nuance, and it's good to see that they reassess, they readjust, and that's what you do when you're wrong. I've been wrong, and you know, more often than I care to admit.
And we'll be wrong many times in the future as well. Here's the quote.
Thank you.
I said we, not you.
No,
Our outlook for this year was always predicated on the idea of seeing a recession in the United States. Greg goes on to say, I think us, along with many people on the street, have been surprised at the resilience of the data in the United States. Not just resilience, Lisa, but so much better than anticipated, just looking at the surprise index. I have to say more recently, though, that surprise index is starting to roll over in the other direction.
It is starting to roll over, although not meaningfully in sort of this sudden spike downward. This surprising resilience has raised a lot of questions among a lot of people, which is how much is behind it and how restrictive are rates and how much further could things go. And people just don't know. And I think that this is really the surprise. How is it that the U.S. was able to withstand 5.25 percentage point increase in benchmark rates without catalyzing some sort of significant downturn, even with all the debt and leverage that everybody was talking about?
That is the great missed call, and the answer is, and this came up a little bit yesterday in my seminar, is the answer is, yeah, we made the move, and as we've talked about for 12 months, the x-axis goes out and there's this longer thing. And if you're longer, you're in a good place.
Because no one's paying it yet. The difference between where the Fed is and where the effective rate is.
Exactly.
If you're in your home right now, you're still locked in at 2-3% mortgages. If you're a corporation, you issued debt in the pandemic, you locked in those low rates for a longer amount of time. You've got to wait. And it's the waiting of it where we start to see it bite potentially further down the road. We haven't had the great refinancing of 5% interest rates just
Ben
yet.
Laidler, eToro was brilliant on this. We're 18 months into it right now.
If you are just tuning in, welcome to the program. Equities right now on the S&P 500, negative here by 0.1%. Tom, looking forward from here, a big debate over in Detroit. The Detroit 3 facing down UAW, going in potentially into a strike a week away.
Fancy elites on Wall Street can walk away from it. Olivia Waxman for Time Magazine does a brilliant send-up. I don't remember this, John, but it was in the fabric of the 60s where you began to get aware of economics and that. 1958 was brutal. There was a guy named Walter Reuther who ran the UAW. He was magnetic. He was really, he just had that je ne sais quoi thing. And Walter Reuther and the UAW in 1958, and Olivia just points out with the Kohler strike then, hugely long strike on the plumbing front, backed by the UAW. And the idea of, at least if you've mentioned the union waiting then versus now, is just stunning, where now we're down to 10%-ish union. And back then, it was the fabric of America, 35%.
Just getting this line on the G20, Tom, cited by a person familiar with the final draft. From what we could get from the G20, a challenge to long-term growth from cascading crises. New book from Al Arian, Gordon Brown, Michael Spence, Permacrisis, a plan to fix a fractured world. What a timely release of that publication.
Absolutely.
Later on. Later on this program, Dan Suzuki of Richard Bernstein in the next hour.
markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
China has made decisions over the past years that have made it more difficult, not just for Canada, but for other countries, to engage in ways, I will admit, in 2015, the conversations we had was about working on towards a free trade deal with China, working towards those sorts of things. But in real terms, the choices and the actions of China have made that more difficult.
That was Prime Minister of Canada Justin Trudeau speaking to Bloomberg's Eric Shasker in the last 24 hours on China, going into the G20 commencing a little bit later on this weekend. The president touching down in New Delhi, India, in about 2 hours or so from now. Some reporting from here at the team at Bloomberg, according to a person familiar with the matter, familiar with the final draft of the communique, or at least the draft of that final communique. Leaders of Group of 20 nations plan to warn that cascading crises pose challenges to long-term economic growth while calling for a coordinated macroeconomic response to it. I mean, how much coordination can we expect at the G20 level?
It took a committee of 14 people to come up with that statement beforehand. I sat with Simon Kennedy once at the St. Regis Hotel where Jon Snow stunned the world with some kind of G20 thing. I remember the room was electric. Are we going to get that in India? I don't think so.
What I find interesting is you have this sort of vanilla G20 correspondence at the same time that we're getting headlines from CCTV over in China that Xi is planning to boost state firms' competitiveness and plans to speed up building infrastructures like energy pipes. This is tangible, on-the-ground types of measures at the same time that G20 can't really come to those agreements to make those strong actions. So I think you're really raising a good point here about the ambiguousness of
Nailed
this.
that.
That was beautiful. It's Friday,
sound like Tom Keene.
Don't worry about it.
Thanks, I appreciate it. All right,
I'm not even going to make an attempt.
Why is the camera still on?
I don't know, it did it to me earlier. It was like Fashion Week Soho. Boom.
Ambiguousness.
Wouldn't let it
there
go.
We go.
Wouldn't let it go.
Right.
Breathe. It's all right.
Saving the program right now in Washington, our chief union correspondent, Amory Horton, joins us as well. Amory, one of our themes is to get out front and look to next week. I believe the President of the United States will return from India, and it returns to something that's the fabric of his youth, and that is a union on strike. I am fascinated, Amory, of your reporting on the union tone inside the Beltway. It's got to be so different from 1958 or from what Biden knew as a senator.
Well, Biden is trying to revive that. This is something he ran on. And as we say a lot, he uses this term a tremendous amount of time. I actually can't keep up. But he says he wants to be the most pro-labor union president in modern history. Part of this issue is that he also has a multitude of goals he wants to achieve over his presidency. He also wants to be the most pro-climate. We've seen at times these ambitions really come head to head, and he has to almost choose where he wants to lean into. Is it the environmentalists and electrifying the grid, or is it the labor unions? But what we're seeing right now is we could potentially see a strike as soon as next week. This contract is ending September 14th, and the language coming from the UAE continues to be fiery. I pulled up Sean Fain's statement. Let me just bring you some of this.
Please.
It says, after refusing to bargain in good faith for the past 6 weeks, only after having federal labor board charges filed against them, GM, which came back with a counter yesterday, has come to the table with an insulting proposal. He also goes on to say that GM either doesn't care or isn't listening when we say we need economic justice.
Right.
The clock is ticking. Stop wasting our members' time. Tick-tock. That is the level of acrimony within these negotiations happening right now. And kind of like when the president went to the G7 in Japan, he had to cut his trip short. He has a number of domestic issues hanging over him when he touches down in India.
Is the nation pro-union? I mean, I got a president who's pro-union and the romance of, what he knew in Scranton and Delaware and all that. But is America pro-union?
I think it really depends on where you live and who you ask. Because while this is also happening, it's been a hot labor summer. You've seen a number of unions and workers really want to demand more from their employers. We still have writers and actors on strike in California. We have a tense negotiation between American airline flight attendants right now after the pilots were able to strike a pretty good deal for themselves. I think it was one of the biggest we've seen in history for the pilots. But if you go to the South, where it's right-to-work laws, you're not going to see very pro-labor individuals. It's right-to-work culture. So very much depends on where you are and also who you ask. Because to John's point, this entire week, the number of people that are actually part of unions has really dropped dramatically than what we saw, say, in the 1970s.
It's easy to say you're pro-union, the most pro-union president in the history of this country when union membership is this low. Because most of the time you can have your cake and eat it. The real test will be if there's a strike. And Anne-Marie, given what the president has told the general public of this country, time and time again, that he believes he is the most pro-union president in the history of this country, shouldn't he be striking with them in a week's time if that strike begins?
I do not think you're going to see the president go to Detroit and take the picket line with these individuals, but he will use the bully pulpit. And what we do know is that he's already has Gene Sperling trying to work in between these individuals, between the big three, between the UAW, to make sure that the government is keeping an eye on these negotiations. I mean, a statement came out last month from the White House about this, about these negotiations, about the potential strike. So when the president says he doesn't think there's going to be a strike, clearly they are worried because they already dispatched someone over the summer and they've even put out a statement already. So clearly they are worried if there's going to be a strike. What does this mean for the impact of the economy? What does it mean for the fact that we already have a low amount of cars that are being built in terms of the manufacturing base, the fact that they've been catching up due to the COVID pandemic and their inability to get some supplies. And also, what does this mean for his EV agenda?
Well, who is the point person for this, Anne-Marie? Just to jump in, we don't have a confirmed Labour secretary. We have an acting Labour secretary. We have a president who, from the outside looking in, looks like he has a cosy relationship with Mary Barra of GM. Who's the point person? Who's dealing with the auto manufacturers within the White House?
Well, I'm sure the Labor Department is involved in this, even though you're right, with Marty Walsh leaving and they've not been able to make sure they can have that Senate confirmation of the acting individual, Julie Su. Gene Sperling has been the person that's been involved with both the big three and the UAW.
Right now, Anne-Marie,
that's the name to watch.
Just real quickly here, just want to finish up with the last question where you mentioned that you're in Washington, D.C., you're not in New Delhi, and part of the reason why is because there's negotiation to prevent this government from shutting down in the near future, and that's one of the exogenous risks out there, a really important thing to be focused on. What are the chances? Does it look more likely that they're going to get to some agreement?
It looks more likely depending on, well, this is another one depending on who you talk to, but if you see what the lobbyists are talking about, we had a Congresswoman Maliotakis from New York on yesterday. No one is saying, no, we're not going to shut down. They are saying there is this potential, and that's what it's looking like. And really what I would watch for is the divide between the Republicans, between the House and the Senate. While you see Senator McConnell come out and say, we want to get this supplemental through, attached to a continuing resolution, that aid for Ukraine, the aid for disaster, put it on top of the bill that's going to keep the government functioning after September 30th, what you see from House Republicans is Speaker McCarthy is potentially looking at ciphering off the Ukraine aid and putting it into a different bill with what Democrats would view as controversial policies for the border and asylum seekers. So there's going to be a huge fight, not just within Democrats and Republicans in the House, but between Republicans between the House and the Senate. And that's why this is going to be really a labyrinth for Speaker McCarthy to navigate.
AMH, thank you. Anne-Marie on the latest. Dan in Washington, appreciate it. Our chief Washington correspondent on the latest of the negotiations between the big three in Detroit and UAW, Tom. Crunch time now into next week and double-digit pay increases on the table, not getting it done.
Yeah, and also the arch call, are we going to get a union group, a labor group, back to a compensation structure that they knew from another time and place? To me, that's the arch idea. They changed it in the bankruptcy crisis and all that. And are they going to change it? Are they going to revert back to it? I guess is the way to put it.
And I think that, you're right to ask John about what the political implication is for President Biden. Where is his allegiance right now? He wants to be pro-business. He wants to also be pro-worker. He's trying to figure out who he can cozy up to.
Come on, his polling ratings are 39%. It's working great.
But it's not because of the labor unions, I would argue.
Yeah.
I would argue there are some other issues there.
Maybe he's trying to be everything to all people, just like you say.
Yeah, I've got no comeback to that, Tom. Earl Davis of BMO, asset management of fixed income, coming up shortly. Your equity market just slightly negative on the S&P. We're down 0.2%.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Live from New York City this morning, equities pulling back 3 straight days of losses on the S&P. Hello, day 4. We're down by 0.2%. Over those 3 days, down not even 1.5%. Not too dramatic. On the Nasdaq, down about 1/3 of 1%. A lot of people looking to Apple over the last couple of days. Over 2 days, Apple, a 2-day loss of a little more than 6%. Going into the big unveiling next week of the iPhone 15 this morning, Apple is down by just 0.1%. In the bond market, 2-year, 10-year, 30-year, looks like this. Yields unchanged. 10-year 424.82, 2-year 494.64. Yields going absolutely nowhere. Snoozy bond market going into the weekend. In foreign exchange, nothing snoozy about it for the last 8 weeks. 8 consecutive weeks of dollar strength. It continues in the last 24 hours. A breakdown from 107 to 106. Been clinging to that 107 handle all morning, and there it is again. 106.98, Tom, on the euro against the dollar.
I'm glad you bring this up. You're right. It's sort of it's a strange Friday, but this to me is a surprise. There's been absolutely no give back on euro. I'm under a 107 to me. It's the 4 decimal points, but it's there. And the other way I'd go is renminbi goes the same way with all the management by the government to almost 7.34. So between the yuan and the euro, those are sort of the items of the day.
It's been quite a week. Some pushback from Japan, some verbal intervention. China trying to push back with a stronger fix over the previous few days. You wonder if we see more signs of them maybe giving up that effort. And then into Europe, the euro weaker when there's an inflation problem, clearly, at a time where the growth story's getting worse, going into the ECB next week. I can't overemphasize this, Tom. The ECB is in such a tough spot with President Christine Lagarde
and
next
even
Thursday.
more in the last 48 hours.
Big time.
I mean, the German data, wow. What does the Bundesbank say? Let's raise rates and bury manufacturing even more.
Manufacturing is already buried. That's the problem, isn't it? Under surveillance this morning, we've talked about it for the last 30 minutes or so. United Auto Workers rejecting a counteroffer from General Motors ahead of Thursday's deadline. GM offering a 16% pay raise, $11,000 in inflation protection for top wage earners, plus a 56% hike for newer employees. The entire offer comes short of the 46% raise in the union's initial bid. Just yesterday, Ford announced it's boosting wages for 8,000 hourly workers. Tom, none of this is getting it done right now into next Thursday.
I just wonder what happens. So they strike. And so they strike for 5 days, 10 days. No big deal. They got a fund. You know, I mentioned 1958 before. But I just wonder what the duration pain is there. Sort of like the actors strike, because a lot of them have second jobs. There isn't that duration pain.
Did they miss the boat? And this is something that's a bigger question about whether the mood has shifted in the labor market and whether the anecdotes that we keep hearing about keep showing that actually there's quite a bit of softening right now in the labor market, and that people are not getting hired as quickly and they are quitting less frequently. Going to the office.
I'd folded in also the Lions upset the Chiefs last night. I think that
Detroit got a win.
You know, they got a win. Oh, that's a big win.
It's a rare win, right?
Michael Barr would suggest rare is a bit too harsh from you on a Friday morning, but you know.
Well, I thought they were terrible.
Detroit's exuberant.
How did a UAW discussion turn into the Detroit Lions?
Oh, come on, it's Detroit. It's a Ford family.
They actually won a football game.
So maybe they'll get this.
I heard Michael Barr talking about that on radio this morning when I was getting ready to come on air. And I was like, oh, Detroit actually won. I'm surprised by that.
Barr's a stud. I mean, from Chicago to Buffalo, he's like known by everyone.
And Michael's going to email me in a minute. He'd be the first to admit that it's rare. More job cuts coming to Goldman Sachs, according to the Financial Times. The firm expecting to let underperformers go as soon as October in a 1 to 5% cut in headcount. Back in January, the bank set out to reduce as many as 3,200 positions in one of its largest rounds of cuts ever. I know exactly what you're about to say, Tom. It's back to normal on Wall Street. Is that right?
Yes. Sonali Basic's going to say calendar item. You know, what's Morgan
It's not
Stanley
a
gonna
calendar
say?
item for the people on the wrong side of it, is it?
I didn't say it was, but this is a
Career-defining.
time of year where you line up, you got Boni in February, and you got to pay your top 10% of your people more money than God. This is what you do.
It also has Goldman Sachs in the headline, and everyone's click, 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 click. Do we understand what's going on with
Yes.
David Solomon? I mean, at a
Yeah.
certain point, you know, that's part of the issue. He was going on and talking about how the stories make him into a caricature, and he doesn't even recognize the person
Yeah,
when
a
he looks
conversation
at
on
it.
the okay,
So,
a conversation with
there's
David over at
also
the Death
that.
Star.
I saw
and,
that interview
You know,
yesterday.
what'd you think? I missed it.
I did a good job with him.
Yeah.
I'm not sure the other guy did a good job
Faber's
responding.
brutal. I
but-
mean, he's just ruthless.
given enough opportunities to act like a human being.
Yeah.
And struggling
He
to
did
act
okay?
like a human being at times. At times.
Pretty much summed it up.
Wrapping up the Fed speak ahead of the September meeting, Dallas Fed President Logan saying, quote, skipping does not imply stopping. Atlanta Fed
Nice.
President
Well
saying the
s- well-
following,
well said.
we're in a restrictive space. And in New York, the Fed President John Williams telling Mike McKee that policy is what, Tom? In a good place. But
Yeah,
emphasizing the need for more data on where we go next.
For radio, we got the 3 quotes lined up. It's a brilliant graphic, John, and that it really shows the nuances that are out there. And you know, I'm not going to pick one over the other because they've each got their own character and their own positioning within the hawkish, dovish parlor game.
We know the phrase high for longer. Goolsby thinks we're just about at that time where it's time to think about the longer piece of this and move away from the higher part of it. Goolsby mentioning that again from the Chicago Fed in the last 24 hours as well. You get the feeling from all of them, hawks or doves, that's the conversation already taking place. If we are sufficiently restrictive, if we're not running a hike or two away from being so, once we get there, Tom, how long do we need to stay here?
Well, the longer is the heart of the matter, and we're going to go to that right now. It's great to have Steve Major with us with HSBC and to have Earl Davis with us today with a heritage with BMO Asset Management in Canada, Bank of Montreal. It's just great to have Earl with us. Earl, I love the pedigree. It's your fault the Toronto Maple Leafs are terrible. You were at Ontario Teachers for years. They used to own the Maple Leafs. They're the ones that buried them into obscurity. You've been on the investment side of debt and also, of course, working with BMO Asset Management right now. And your code here is longer. We are going to be longer. How longer is longer for Earl Davis?
Yeah, I think we'll be higher for longer for, most likely until 2025. I don't foresee any cuts next year for 2 reasons. One is all central bankers are telling you that, and I think we have to believe them. The other thing is you see the economic numbers, right? The resilience. Even though I know you guys were discussing jobs and the decline there, but there's still excess demand for workers. It's still positive. So the question is not whether things are declining, it's whether they're declining fast enough. And I believe some of the secondary data that we're getting is telling us no. And that means if they're not going to hike too much more because they have to wait to see the cumulative effects of hikes, they have to hold on for longer.
Accumulate us across 2024 to year 2025. How does fixed income react to a longer that most people aren't predicting like you are?
Well, the interesting thing is we don't believe there's hikes next year. We believe there are hold next year. So what happens in that environment is that the longer end of the curve starts doing the fight against inflation, and that comes through the market doing the fight against inflation. So there's 2 things that have to happen first. One is the market right now is discounting eases in the 2-year bond all throughout next year. I think there's 4 or 5 eases discounted in the U.S. That has to work itself out, and that means higher yields across the board. But we believe we'll have steepening before because people are scared of the UAW negotiations. What's the impact of that? Because let's say there is, for argument's sake, a 25% increase in wages. That does not show itself immediately in inflation, but it will show itself in 6 months as car prices go up because your costs are going up. And this is happening across a number of industries. So we believe we are in that wage price spiral. We've seen a number of wage gains this year, your pilots, we saw UPS, significant wage gains, which doesn't show up in inflation until people start paying and buying stuff with that increased income. So we believe we're in that spiral. That's why it'll be higher for longer. And we don't foresee cuts until 2025. At earliest, late Q4 2024, but I don't anticipate that at this point in time.
We talk a lot about the long and variable lags, and there's a huge disagreement about whether they've already basically impacted on the economy or if they are yet to come. Aside from just the Treasury market, when you take a look at credit, Are you seeing companies being able to absorb some of the higher rates and all of the debt sales that we've seen over the past couple of days? Or is there something else going on that makes you think it's going to bite in a more material way?
Well, they could easily absorb the debt hikes from where they're refinancing. And the reason why is, let's look at U.S. 10-year bonds. Let's say a company issues U.S. corporate credit you know what, say 100 above overnight, above 10-year yields. They're still earning a positive return. They're not paying because of the inversion of the yield curve and where overnight rates are. So it's not costing them as much as people think, especially the ones who issued last year or the year before and still have 5, 6, 7, 8 years left on this debt. I think this is part of the story and part of the reason why we're seeing the resilience in the market that we're seeing, especially from corporates. There's no earnings recession. There's no margin compression at this point in time. And that's something that has to change for inflation to come down as well.
If you do have some sort of wage price spiral, are you saying, Earl, that we're on the cusp of a reacceleration of the U.S. economy that people are not foreseeing, and that slow sort of soft landing and decline is not an accurate portrayal?
That's a great question. The answer is it depends. And it depends on what the Fed and FOMC reaction to that is. You know, it's our belief it's going to be very difficult for them to hike in 2024 because of the election. And I know they're independent, but it does impact popular opinion when politicians are talking about hiking, when things are turning. So it depends on the reaction function of the Fed. If the Fed chooses to counter that reacceleration, if it does happen, then no, we'll be all right. But if they choose to wait because of the cumulative effects and because of other reasons, then we could see some ongoing volatility in the bond market, especially that 10 to 30-year sector.
Oh, that word but. Can I pick up on that? They're independent, but I've always struggled with that, Earl. They're either independent or they're not. There's no buts about it. Why is there always that but?
I'll give you the but. Let me answer that question for you. They are independent, but the politicians, Congress, Senate, they could change the mandate of the Fed in 5 years. So they're independent now, but the reaction function in 5 years in regards to the ongoing mandate, that's subject to change. That's not permanent.
Interesting. Oh, you think that might change then?
I didn't say that.
I'm just asking.
That is in the cards.
Okay.
So that has to be taken into account. Let me look at it, rephrase it. I'm a fixed income trader. I look at net present value. So which means your cash flows over the next 10 years. When the FOMC makes a decision, they have to look at what's the impact, not just immediately, but next year, 2 years, 3 years, 4 years, 5 years. Part of that calculus is what I'm saying. And that's what you have to distill back to ensure that you have longevity in what you do. And that's how we kind of see the game theory of monetary policy, fiscal policy, and that's how we put our risk on. We look at this and we incorporate that into our risk taking.
That's fascinating. Oh, thank you. Thank you for the explanation. Oh, Davis there of BMO Asset Management on an independent Federal Reserve.
It's a conversation of the week there in fixed income. There's just no question about it. That is an outlier call, to say the least.
If you are just tuning in, welcome to the program. Your equity market shaping up as follows on the S&P 500, negative here by 0.26%. This from Andrew Honhorst and the team over at Citi. Base case. The FOMC will skip hiking at their meeting this month, then deliver one final 25 basis point hike in November. It all depends on core inflation picking up somewhat in August and September and the labour market remaining tight. If that happens, Tom, if that's the case, they believe there's one more to come, and that one more comes in November.
So they're data dependent. Andrew Hollenhorst is data dependent.
Essentially, that is what Andrew is telling you.
John Williams at a good place is data dependent.
Well, here's what I'm thinking about a lot, which is we're clearly shifting to a place where they're going to be on hold, right? Where they're not going to be raising rates further. Whether they raise rates one more time or not, or whether they raise it 2 more times even, does that really make that much of a difference? What are the criteria to shift away and to start cutting? We still don't have any sense. We have the John Williams view of things, and then we have the view of things of we're never going to cut because we don't know what's going on. So this, to me, is really how do you game out beyond that, which is basically what markets are trying to do.
It's counterproductive for them to talk about it. We've talked about that a few times. Counterproductive because there is still an effort to get inflation down, and once you start engaging in that conversation with any depth, detail, Tom, once you start doing that, you could get a premature easing of financial conditions, and I'm not sure they want to go there right now.
It's just a bunch of what if. I'm waiting, what is it, the 13th of September?
Tom, markets is a bunch of what if. isn't it?
Okay.
Isn't it the whole business?
Who's the hottest team in baseball?
That's the only tangible thing we can discuss.
Who's the hottest team in baseball?
I don't know. Who?
The dreaded New York Yankees are the hottest team in baseball. They're playing 5-0. They're 8-2 the last 10 games.
Didn't they just lose?
I know they lost. They're 8-2.
Okay.
They're on a tear.
Torsten Slok, Apollo, in the next hour. From New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do. We'll have to keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again?
One of the best, if not the best, Mike McKee, sitting down with the New York Fed President, John Williams, here at Bloomberg at our headquarters in New York City. We're in a good place, TK, according to President Williams.
Well, he said all the right things there, but to me, the heart of the matter is his comment on data dependency. And next week is a big week for Bloomberg surveillance. We start right off on Monday and dash to the PPI, the CPI.
CPI on the 13th, yeah.
Northern Macedonia.
ECB on the 14th, they'll ignore
results.
you. Next week, the Federal Reserve after that.
Yeah.
You want to talk about the football this weekend? Let's avoid that altogether. Can we bring up Apple stock? Let's take a look at that stock over the last couple of days. 2-day losing streak. Those 2 days down more than 6%. Down more than 6% over the last 2 trading sessions, Tom, off the back of this story of China banning some iPhones at the government level, potentially state firms as well, based off our reporting. That stock got hammered yesterday by about 3%. Going into this iPhone launch next week with Huawei potentially providing a little bit of conversation, a little bit of competition. This is a change, TK, from where we were a few weeks ago.
We welcome all of you worldwide, particularly in the evening across the Pacific Rim. On Apple, Bloomberg is definitive. We have a gentleman named Mark Gurman in print who writes with great authority on this worldwide. He has published overnight. I've gotten that out on Twitter, and I'll do it again. Look for that from Mark Gurman. And as well as Mr. Gurman, we have Mr. Webb. Alex Webb is a student of all this technology with a global reach out of Queen Victoria Street in London. Alex, does Huawei have an ecosystem?
No, is the short answer, although don't forget that their operating system tends to be built on Android, which is the Google ecosystem. The challenge, I think, for Huawei, which has got this new device that, from a headline perspective, appears to be challenging the iPhone, are they able to make enough to challenge the iPhone? But don't forget, when we think about China and we think about ecosystems, it isn't the same as in our part of the world. They use WeChat and that whole sort of super app platform, which means it's easier potentially to pull yourself out of an iPhone and go into an Android or vice versa. Whereas the platform I use is this one. It's the iPhone. It's iOS. That is my super app.
What will Apple do? We've had a lot of speculation here about how they'll respond. You know the people. How will the management of Apple respond to the last 48 hours?
They take a long-term view. This has happened previously where they've had, for example, they issued a profit warning, I think 4 years ago, and all of a sudden everybody started writing off Apple. They've now, $3 trillion valuation. So they will probably say, don't worry about this. This is a small-term blip. They've had a blip in the past as well when there was a sort of resurgence of nationalism when it came to purchasing in China. People being encouraged to buy Chinese-made devices. Say the iPhone is a Chinese-made device, but owned by Chinese companies, and Apple had a bit of a hit for a quarter or two. They tend to take a long-term view on this stuff, and I'm sure that's the messaging in Cupertino.
Alex, one conversation we've had around the desk today and over the last couple of days, actually, for Apple and Tim Cook. Tim Cook's been a phenomenal diplomat, navigating that tension between the US and China and seemingly not upsetting either side, even when the former President Donald Trump was in the White House. Alex, if Apple is in the crosshairs of this now, I'm thinking about everybody else. Alex, who are you focused on beyond Apple in China at the moment?
Wait, in what sense? You mean in terms of other Western companies with exposure?
Absolutely.
Well, the whole Apple supply chain, basically, right? These are the people who occupy vast tracts of the tech industry, the likes of Qualcomm, who, they've also taken a bit of a hit as a consequence of this. I think, to your point with Tim Cook and the way that he straddles that divide, Tim Cook, in a sense, is a very useful figure to have, almost at times arguing your corner from the Chinese perspective. He needs access to China, both from a manufacturing and a market perspective, because they make all the devices and they are the second biggest market. So Apple needs China. China benefits also from having that sort of symbiotic relationship with Apple, because he is able to argue the case in some instances on Capitol Hill, say maybe don't carry out quite the extent of sanctions that you would otherwise want to do.
To exactly that point, Alex, at this point, doesn't Tim Cook have almost more of a free leash to basically go to India, travel over to New Delhi and say, hey, let's start ramping up production here?
Yes and no, right? It's taken 15, 20 years for Apple to build out this supply chain in China. It's not something that happens overnight. At the same time, India is nowhere near as mature a market as China right now. China does something like $75–80 billion in revenue for Apple. They did, the most recent numbers we have from our own reporting in March is that they did $6 billion annualized revenue in India. So there's a huge delta there for them to catch up. It's not as though you switch from one to the next, from 1 year to the next. It's going to take a hell of a lot of time.
When you talk about how China does depend on Apple, is this sort of flying in the face of that, or is this basically just casting similar things that the Chinese government has already done in new ways, right? I mean, this is something, for example, the encouragement of state-owned phone companies or manufacturers, that was always encouraged in some of the state workers, right? Some of these things are being trumped up at a time to really push back in the public eye against the U.S. What's your view?
Look, we are starting to see a real tit for tat happening in terms of the U.S. introduces one set of sanctions, the Chinese responds by blocking access to the market for one company. This seems like a relatively, actually, easy thing for them to do. It's kind of at low stakes, despite the market reaction. You're probably looking at 1% of their total sales or unit sales in the region affected by this. The bigger question is the mood music, right? Does it affect demand from the broader Chinese market? It's unclear that that's going to be the case,
Alex,
but that seems to be sparking some of the concern.
We didn't have you on for all this mumbo-jumbo about the mood music. When they do their product launch next week, is it a big deal that they changed the pluggy thingy into USB thing on the new iPhone? Is that earth-shaking?
No, I mean, it's also not something they're doing of their own volition, right? It's something they're being forced to do by the European Union. but you assume, therefore, people have these plugs already. Like, that is something around the fringes that makes very, very little difference, despite how they might present it next
when you
week.
watch that stupid show, to me, it's the most contrived thing ever.
Which show?
The Apple show.
Which one?
The launch. You know, they're going to do the
Wanderlust next week.
What's it called?
It's called Wanderlust, isn't it? Something like that.
Really?
Yeah, that's what the
I mean,
event's called
Alex,
next
do
week.
you care oh my God, they're wearing a turtleneck? Or, give us the backstory on the show, Alex Webb.
I mean, look, I have very little tolerance for those things. I've been to plenty of them. The thing that's, you hear all these people applauding in the room when they were in-person events, which they're not anymore. The thing you've got to remember, most of the people in the room are Apple employees who made this thing, right? Those are the people who are applauding.
There we go.
The people who are sitting there quietly typing away at the laptops are the like of me and Mark Gurman, who are, doing our jobs as journalists.
Is there going to be any surprises?
What surprises are you looking for?
I don't know. Well, the surprise is 2 iPhones in the house have broken in the last week. That's
Unsurprising.
a shocking surprise.
Perhaps. Alex, we have
Alex
to leave it
has
there.
to actually do this.
We have to follow the clock too, Tom. Apparently he's got to go. Alex Webb.
Oh, sorry.
Thank you, sir. Out of Bloomberg in London.
I mean, you and I get
The
to
latest.
laugh about it. He and Gurman have to actually go to
Ed
the
Ludlow
show.
too. They have to deal with this garbage, yeah.
My favorite is that this image of all these workers clapping, and then the reporters in the sidelines being like,
I'm pleased we're done with the lines around the corner from the store and people have just figured out you can get this thing delivered to your house.
Yeah.
They just order it through the telecoms company, whichever one you might use, and it will arrive. It's pretty simple, TK.
Yeah, I just, I just think it's a lot. I mean, I get the Chinese angst thing. China's in huge turmoil right now.
One thing
Somehow
that,
it'll get fixed. It always gets fixed.
One thing that Apple's done really well is just branding and style. I mean, that's sort of where it won, right? That Steve Jobs won on style and aesthetics.
Luxury.
Sort of, right, and
Galloway
it's
talks
a
about this.
luxury
He's been
good,
great on it,
and then it's also, a staple. And so the idea of Wanderlust, does that create an ad to this style and the hype?
It's going to have a lighter
Around
weight.
Fashion Week in New York.
You wanted to bring that. You want to go back to Fashion Week.
A lighter weight titanium frame.
The problem is, Tom, they've made this one so well. I don't need to upgrade this thing anytime soon. I'm not a professional photographer.
I upgraded.
I don't need the brand new camera.
The last toy.
So long as the battery lasts.
The
long
battery.
enough.
The last toy, the battery is game changing.
And also just the charging connector. Had to have that replaced recently.
Yeah.
Whatever. Michael Barr writes it. Michael Barr writes it. How rare is that win? Against the defending Super Bowl champs, and convincing. It wasn't a lucked win. He says, Lions strong.
There we go.
That's your Detroit report this morning. Dan Suzuki of Richard Bernstein up next.
The middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The market is waiting to see a definitive turnaround.
We think about potential GDP in the U.S. that's somewhere between 1.5% and 2%.
There is so many moving parts. There's so much data which is really contradicting each other.
It seems like the desire is to pause and wait a little bit.
It would be so historically unique to see a soft landing here without a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We're in a good place on a Friday. Resetting for September, the quiet period for the Fed. This resetting for October, November, December. The difference of opinions today, John, on the show, extraordinary. Steve Major, HSBC, lower yields. Earl Davis, BMO Asset Management Canada. You got to be kidding. We're going to be longer for longer.
Seema Shah said it, contradictions in the data and in the markets right now. So let's talk about a few of them this week. The data, jobless claims, the lowest since February. Claims are moving lower. Never mind that break in the labour market.
Morning in America.
At the same time, the ISM pretty strong earlier this week, Tom. That conflicts with what we heard from the beige book. The slowdown story, China, Europe, that conflicts with what we see in the commodity market. Crude at highs for the year. Iron ore at multi-month highs. When you have those kind of contradictions, Tom, it's confusing. So for the Federal Reserve, they're going to wait. They're going to be patient. They're going to skip September based on the communication we've had from them so far. Yeah. Whether that changes with some big CPI print next week, it's not anticipated or expected, but things can always change.
I'm on my way to the November meeting already. I mean, I just think that's where we
Hot
are.
horse this too.
In the bet on is Torsten Slok that we with us, I believe, in this hour. We're going to have an equity conversation coming up, which is really the conversation of the day with Mr. Suzuki working with Richard Bernstein, and it does fold into the stock market bet. Apple, OMG.
2 days of losses, Tom, of more than 6%. It's going into the unveiling of the iPhone 15 next week. There's two stories you have to look at. Competition from Huawei, potentially, with their new phone. And secondly, based on reports from the Wall Street Journal and from us here at Bloomberg in the last couple of days, that this iPhone ban is spreading. It's getting wider from state agencies in China across to state firms maybe as well, Tom.
Lisa, yesterday, Anastasia Amoroso, I'm sorry, let me paraphrase, load the tech boat.
Well, she was saying that in terms of the AI bet longer term, but then we were hearing from Amy Wu Silverman of RBC Capital that there was something that preceded the Apple noise, which is a shift in tone among some of the traders, people getting less long, less bullish, a little bit more caution really coming into some of the trades that we've seen so far. This is a really uncomfortable moment because it feels like we're on the precipice of some change, but people don't know which way it's going to break in, and you see that reflected in some of the uncertainty in the market.
Well, then make the call, Lisa. Which way is it going to break?
Really? Okay, thank you.
Yeah, I'm going to ask John the same question.
Well, clearly to bearish side. No,
it's Friday. We're into the season.
Kind of.
No, actually, to be completely honest, there might be a bigger risk that there is a reacceleration, that things keep going better than expected.
Yeah.
And we saw this from Michael Hartnett today of Bank of America. The biggest risk to stocks is not a recession, is not an actual catastrophic event that causes rates to come down. It's that yields remain higher for longer, that things keep chugging along. That creates a very different valuation perspective for some of what's out there.
We stopped the show worldwide for a report. We're pleased to have with us our chief football correspondent. This from Bloomberg. Saudi clubs spend 87% of $1 trillion on football players in, quote, summer frenzy. I mean, Saudi's trying to buy up sports, right?
So that transfer window just closed in Saudi Arabia, which is why we now have the official tally of $875.4 million. And it could have been more. They were after Mo Salah of Liverpool. There were numbers being thrown around of 200, maybe 200 plus. So that number could have been a lot more. It's not going to stop there.
Wait. Did the Red Sox give him $200 million so he wouldn't go and stay with Liverpool?
I'm not sure what Fenway Sports, who also own the Red Sox and Liverpool too, so I can explain that for people who don't know. I'm not sure, Tom, what
Julie
they offered.
Swinehart wrote out a check for $200 million.
This isn't over. Now, some of the European clubs are very unhappy with the disruption coming from the Saudi teams offering up a load of money. There's another side to this story. European football has had absolute dominance over talent for decades now.
Right.
A monopoly on the best players from Latin America, from Africa. They're all playing in Europe. And now we have a different destination available to some of these players. Not necessarily just the ones at the end of their careers. It's going to be interesting to see what the younger players at the top of their game do.
How can they say no?
I
mean, you can get, am I right? You can get, I mean, the guy from Man City, the tall blonde guy in the front, his father's career was ruined, right?
By injury.
By injury. I mean, these kids live this, don't they?
As far as I understand, Kylian Mbappe said no. So there are players at a younger age in their early 20s who are saying no to that money.
Are they saying no and getting, does Salah have the Red Sox do this so the Red Sox fall into last place?
The likes of Kylian Mbappe are getting huge sums of money. His contract's set to end, I believe, next summer, and we'll see if he goes to Real Madrid, and we can talk about the numbers then. I'd actually like to compare these numbers out of Saudi to the numbers in the Premier League, and I don't have that in front of me right now.
Well, the Tots didn't spend $875 million on whatever debris they have after Mr. Kane over at the Bundesliga. That's your football report for the day. We welcome you. We'll try to save the show with a data check right now. John, I'm going to steal your thunder. 107.03 on Euro can't get out of its way.
Thunder stolen. 106 just moments ago, Tom, in the last hour or something. 107.03. We're positive on that currency pair by 0.1%. Dollar strength, the story for the past 2 months. 8 consecutive weeks of dollar strength. In the bond market, yields higher by a single basis point, 425.42. Equities just a touch lower here. We're down by 0.1%, Tom, on the S&P.
Here in the first week of the season, we need to recalibrate on the equity markets. You can do that with the shop of Richard Bernstein. The deputy CIO at Richard Bernstein Advisors is Daniel Suzuki and joins us this morning. Daniel, Richard Bernstein's work is definitive. Style investing was classic near 30 years ago, and so appropriate right now is Bernstein Navigate the Noise, investing in the new age of media and hype. It's like you could redo the book this morning. Help us navigate the noise right now. How do you go long stocks amid all of this 2023 noise?
Yeah, Tom, that book was written, well before the age of Twitter and social media. So you can just imagine, the exponential growth and the amount of noise out there that you have to ignore. Ultimately, I think it behooves investors to come back to brass tacks fundamentals. And that's really, what are the profits doing that you're buying and how much you're paying for those profits? And I think people have lost sight of that, and people just invest in stories without a care for those underlying fundamentals. Now, the profit story for a lot of these companies out there, no matter what sector you're talking about, is still pretty good, and we think it's going to accelerate from here. So I think that is very positive. On the negative side, though, people have no care for how much they're paying for some of these stocks. And that's where I think, the rubber meets the road. I think people are paying too much for certain areas of growth. They're not paying enough for other areas of growth. And Tom, you alluded to style investing. One of the core tenets of that is as growth starts to accelerate, we think profits growth will start to accelerate over the next couple of quarters. investors will become comparison shoppers and realize that there's no need to pay 30 or 40 times for companies that can grow at double-digit earnings growth, where there's other companies that trade at a fraction of the cost that can grow at multiples of the growth rate. And I think that's the classic rotation that we could see going forward.
Okay, so are the Magnificent Seven among those that are too expensive, or are they the ones that have the best growth picture going forward?
Yeah, I think from both sides, Lisa, I think on one hand, I think they are the crowded, expensive part of the market. If you take those seven or the sectors encompassing them, if you take them out of the market, you're looking at very, very reasonable or very, very cheap valuations everywhere else in the world, in every other sector of the world, right? So that is the one area where things are expensive. Now, does the growth justify those valuations? You know, I think that because, as I was saying before, people have gotten so excited about the growth prospects, you know, the growth expectations are very, very high. And I think those growth expectations are going to get dwarfed by the traditional cheap cyclical areas of the market that are more sensitive, you know, to the pickup in profits growth that we could see. So I think there's potentially risks on both sides, Lisa.
If there is a pickup in profits, as you see, and particularly in some of these areas that haven't gotten as loved as the Magnificent Seven, what does that mean in terms of the new neutral rate and what that kind of does to forward-looking returns? I mean, if you have benchmark rates that stay around 4%, doesn't that materially change your valuation lower in some of these equity markets?
Absolutely. I think what you're saying is that if growth is going to accelerate and inflation is just demand outstripping supply, demand's going to pick up. And inflation pressures are going to pick up, and that's going to result in a tighter Fed and higher rates, and we're going to have to, you know, price that in. And I think in that world, you know, there's certainly an argument that the more expensive stocks should trade cheaper. But as I said before, there's really one expensive part of the market that's ultimately at biggest risk of that higher rate scenario. The rest of the market, whether you look at the equity risk premium or just the pure valuations, are actually still quite reasonable.
Dan Suzuki, how do you and Richard Bernstein avoid a Disney? What a disappointment. What a strategic seismic change in an industry. For our viewers and listeners, how do you avoid a certified blue chip stock that falters?
Well, I think you got to stay away from just investing based on the story. You know, the story got everybody excited about the growth prospects, the new businesses, the technology applications, you know, the franchises that can't, you know, that you can just rinse and repeat. And I think that the story got a little too exciting and people got too overhyped about that story. Again, that's going back to navigating the noise. Ultimately, comes back to, you know, what are the profits doing and what's the macro environment and how conducive is it to that story. And I think that's where, you know, you ran into a little bit of a, you know, expectations getting a little too elevated.
Dan, thank you, sir, for the update. Dan Suzuki there, Richard Bernstein Advisors, RB looking for opportunities in the rest of the world, Tom. Seemingly the international story for them, not as dire as it is for others.
Style investing, nearly 30 years old. It is one of the great, I'm going to take 5 great books on equity investment, John. It's a little bit of a heavy lift. There's some real meat in there from Richard Bernstein, but I can't say enough about the intelligence of that effort. It was seismic when it came out near 30 years ago.
If you are just tuning in, welcome to the program. Your S&P 500 negative over the past 3 days, trying to avoid a 4th day of losses. We're negative here on the S&P 500 futures down by 0.1%. Coming up in about 18 minutes time, 8:30 Eastern time here in New York, we'll catch up with Torsten Slok of Apollo on the path forward. Always has great charts every single day. Torsten just churning it out over at Apollo. And in just a moment, don't miss this, Pierre Ferragu of New Street Research on Apple after a tough 2 days going into the unveiling of the iPhone 15, Tom, next week.
Really important voice. He is not a fanboy. Just as simple as that. This is a guy doing securities analysis wrapped around not a skepticism and not a meanness about Apple, but just always considering that premium valuation that's been placed on it.
Apple at the moment in the crosshairs of tension between the US and China, and maybe in the mix as well, this Huawei launch. On Huawei, we heard it from Alex Webb in the last hour.
How do you pronounce it?
Is it Huawei? Huawei?
I'm asking you.
Okay, we'll try that with Pierre Ferragu in a moment.
Yeah.
On that particular company, which has launched a new phone and an update, debuted a more powerful Pro Plus, whatever that is, a little bit earlier on today, Tom. On that particular phone, something you heard from Citi, you heard from Alex Webb too, do they have the capacity to produce it?
Yes.
In mass to compete with Apple and the iPhone 15?
I don't know. I don't know the price point or that. All I know is like Samsung, OMG, Apple's going to die. Samsung's got a new toy, Android, blah, blah, blah.
We've done this a million times, granted, I
We
understand.
said it.
Totally.
I'm like,
I know.
okay.
I know. Are we going to move on? No. We're going to ask the same question.
I'm on my
in about
edge of
5
Larry
minutes.
Haverty right now.
What's that mean?
Larry Haverty used to laugh at the people that would say Apple's going to die. They just, the product's over. This won't work. These AirPods will never work.
I was one of those. I didn't want to wear the AirPods to begin with.
They don't fit
I waited for everyone else to use them, and now I use them all the time. Mainly to stop people from talking to me. You just walk in with.
I wear the Beats.
Walk around the office with them. You wear Beats.
I wear the Beats. The
That
red
suits
ones.
you.
The
That
Bonham.
suits you. Nice.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
The smart people, I believe, recognize that the R-star is unchanged from before the pandemic. So the policy rate is more than double what the equilibrium rate is going to be. So it says to me that we are at or very close to the peak in the cycle.
The bond market bull is still bullish. Steve Major of HSBC. Welcome to the programme. Counting you down to the opening bell, about an hour and 15 minutes away. Going into it, futures negative just slightly through most of this morning. We're down by 0.1%. Apple just a little bit lower as well. 2 days, losses of more than 6%. We're down here by 0.2%. We're looking ahead to next week, Tom, just around the corner, the iPhone 15.
Going to get right to it right now. This is an important conversation. Pierre Ferragu has been just brilliant and decidedly not an Apple fanboy. He is global technology infrastructure head at New Street Research. Pierre, I love your phrase, the Silicon Wall. I'm going to give you credit for that, the Ferragu Silicon Wall. That's attention this morning. Is there a Silicon Wall identifiable between America and China?
Well, I don't think we see the wall yet, because China is buying about 20-25% of any Western tech company or any Western semiconductor company. So there is still China is still a very big market. But what we see is that both sides are working very, very actively at building up that wall, with the US, increasing restrictions, China doing their best to develop their own supply chain. And you see, like with Huawei this week announcing their first, high-end phone powered by by a homegrown chip. These moves are very important and are setting the foundations for the world in some ways, and that's the way I would think about it. And it took like a few centuries to build the wall of China, and it's probably going to take a decade or two to build the Silicon Wall as well. It's going to take a very long time for China to be able to be more autonomous and for their ability to replace Western suppliers.
Your note, Pierre, your note is extremely constructive on short term for Apple in China. What is the power, the sway that Tim Cook has over the Chinese government and over the Chinese manufacturing establishment?
So let's, I think you raise a good point that, China has to, be very careful to what they do with Apple, because China depends on Apple for many things. They are even more important in the upstream of Apple than the downstream of Apple. That's a very good point. But even if you take a step back, let's talk about Elon instead of talking about Tim and see what happened in 2021. China banned the use of Tesla cars for a similar scope of Chinese officials, Chinese military, state-owned companies. And how is Tesla doing in China these days? Pretty well. So, these bans, the direct impact of these bans is very, very, and to be honest, actually invisible. You don't even see it. And so that's the reason why I'm a bit constructive on the situation. You're like, this ban is not going to affect Apple in the near term. Of course, it's a wake-up call for investors. They're like, oh my God, this situation with China is not getting well. And I think the ban is one thing, the Huawei phone is another one, and it's not a coincidence that we see the two things popping up in the same way. So the way I see it, whether it's Tim Cook or Elon Musk, these guys have a good ability to engage with Chinese authorities, understand the importance of China as a market. China understands the importance of having them building factories, leveraging the Chinese supply chain, and so. Nobody is going to mess the Apple cart in the near term. But in the longer run, I think you have to keep in mind the Silicon Wall is building up, and slowly but surely China is going to get out of the mix of the revenues of an Apple, of a Tesla, of an Intel, of all Western technology.
So at what point are you looking to see how much Tim Cook heads over to New Delhi, to Mumbai, to really have a discussion about expanding production in India?
Yes, exactly, very similar, very slow moves that are going to play out over years and years. So it took China like a few years, to be able to put out a chip that could power a phone that could more or less, compete with an iPhone. But still lag well behind, revenge is a dish that is better that tastes better cold. And now China is starting to putting up this phone and in a position to start pushing back on the iPhone. And Tim Cook and his team are very clearly, cognizant of that, and they're making sure they're lowering their dependency on China as well. So that's the wall building, slowly but surely.
I have to say, this is a frustrating conversation to be having, not because anything that you're saying is frustrating or not incredibly interesting. It's more just going forward that it feels like we have all these geopolitical headlines, and then we have people coming on and predicting with really no basis of whether this is something meaningful or something this isn't. How do you just deal with this? You just discount all of the geopolitical headlines as near-term noise and look at the fundamentals and say longer-term maybe, but we have to really wait and see.
Yes, Lisa, I wish I had started a hedge fund 24 months ago, just buying the dip of every geopolitical headlines, and I'm pretty sure I would have made a lot of money. China, the Silicon Wall, the tensions between China and the West. The way I like to frame it is the following. Let's say China is on average 20% of Western tech. And let's say in a decade or two from now, in 15 years from now, China is out of the picture. That means Western tech is going to lose barely a point of growth every year over the next 15 years. So yes, you can reflect that in your DCF valuation and things like that, and it's going to give you a single digit, headwind on your valuation if you're a fundamental investor. But at the end of the day, it's not a big deal. It's not. We are ready for that, and because the market is what it is, every time there is a piece of news, it's massively overreacting on something that is going to play out over 15 years. So yes, I tend to see each of these reaction as a buying opportunity.
Pierre, I'm happy to look at opening that fund with you. Look forward to working together. Pierre Ferragut of New Street Research. Pierre, thank you, buddy. Always great to get your perspective. Going into that unveiling of the iPhone 15 next week. Going into the next hour on Bloomberg TV, Mohammed Al-Arian of Queen's College, Cambridge. And of Bloomberg Opinion, Binky Cheddar of Deutsche Bank, Sarah Hunt of Alpine Saxon Woods, Dan Ives of Wedbush coming up as well. Mohammed in the FT this morning talking about China, Tom, and why it won't necessarily become the world's largest economy because of the challenges domestically. So a lot of things we've got to talk about here. China, the economic challenges. China, the iPhone. We'll do that with Dan Ives in this equity market with Binky and Sarah TK around the opening bell.
That's a great mix of people there. And granted, you've got two bulls there with money in the market in Chad and Sarah Hunt. But the summary to me is the tone of those four guests is about American exceptionalism, which is a foundation of what John Williams said yesterday. You know, there's all this uncertainty and the toxic brew that's out there and da-da-da-da-da. You know what? We're doing okay.
He gets to say we're in a good place. And we get to say we're in a good place relative to right now, not just China, but also Europe, Tom. Chairman Powell is in a much better place compared to President Lagarde. Chairman Powell, without a doubt, on September 20th, does not have the stress that Lagarde has to confront a week from yesterday, TK, when the ECB convenes at the Governing Council. They've got a much, much tougher decision to make through the next several months, given what's happening with that economy and to Germany specifically.
And with Torsten Slok, who was with me on a panel last night, I guess he's joining us here in minutes, and the answer is, you know, there's this turmoil where America just, it seems that every conversation comes out better. How do you bet against that?
And not our opinion. Push it through the FX market, Lisa. 8 weeks of dollar dominance, 8 weeks of dollar strength speaks to exactly what we're talking about.
I was reading this one estimate, I think it was from Deutsche Bank, that taking the $190 billion decline in Apple valuation would have put it in one of the top 11 stocks of the
amount they lost.
Of the stocks, just to give you a sense of how that relative valuation would be over in Europe, which doesn't have the tech story. And oh, by the way, didn't have the fiscal stimulus story either, and I think that's going to be a big discussion.
It has Novo Nordisk now.
Yeah.
Right?
I mean, come on.
And that's benefiting from what? U.S. exceptionalism of a different kind.
All right. You trolling us?
Different kind. Not at all. I live there.
Sugar lobby?
Part of it, something like that. From New York City, if you didn't get the joke, that's probably a good thing. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance on a Friday, getting you into the weekend to a hugely eventful week next week. Lisa Bramwitz and Tom King, Jonathan Farrell in deep preparation for the next hour.
He's in a quiet period.
He's changing in a bright yellow to interview Dan Ives here on Apple. Dan Ives.
I love his outfits.
Yeah, well,
it's so great.
Fine. Could you see me in that look? I don't think so. Dan Ives in the next hour on Apple with his enthusiasm yesterday. There's some gloom pushing against Ives. I mean, there's some tangible.
Yeah, the market.
The market is down 8%, 9% on Apple, and it's like, okay, now what?
Well, yeah, Pierre Ferragut just said that he wanted to go back a year, 18 months, and create a hedge fund to buy every dip in Apple shares on geopolitical headlines, and he would have made a killing. And there are a lot of people who kind of are doing that playbook right now.
There's no economic data at 8:30 right here this morning.
No, there's none.
But his agent called and said, put McKee on so we can talk about Williams yesterday. So here's Michael McKee doing a victory lap here on what we saw with John Williams. There was a surprise in there. You always crowbar it out of every Fed official. What was the Williams surprise yesterday?
I think that people may have been surprised by the fact that he's not doctrinally wedded to our star. It's a useful item, but it is not something that guides his policy making because, as he admits, you don't really know what it is in real time. His monetary policy stance is pretty much as it has been for a couple of weeks, and as most of the Fed officials are feeling right now, that they could skip. The data will tell them, and I think they're just waiting for the CPI more or less to give them a rubber stamp to skip than anything else.
Do you feel like Fed officials right now are kind of happy? They don't want to seem happy. They don't want to seem satisfied. But do they just kind of feel pretty happy?
There's no fun allowed.
Yeah, no. Well, I mean, just in terms of that things are in a good place.
Yeah, I mean, Williams summed
landing.
It up. If you were trying to design an environment that you would achieve from your policy, this is it, where you've got still relatively strong growth and you've got inflation coming down. Will both continue? They don't know, so they can't take too much of a victory lap at this point. But this is not what people expected a year ago. I mean, recession was the base case.
We've been talking about the UAW potential strike and some of the discussions with the Detroit Three and what this could mean in terms of both where the supply and demand is in the labor market, but also just how sticky inflation could be. How are Fed officials thinking about this? Are they paying attention?
Well, they're definitely paying attention because it would have an impact on the economy. We're talking about 150,000 workers at unionized auto plants, and then you've got a spillover effect to the suppliers who have to decide whether they're going to keep producing and build up inventories that aren't getting used, and they may not be getting paid for right away. So there is a knock-on effect, but you can't know if they're definitely going to do it. That's the problem. And then you go into it knowing that the strike will happen and then it will be over. Right. And then it works its way out of the economy. And so do you make policy based on that? Probably not.
Michael McKee, thank you so much. An important conversation yesterday with the head of the New York Fed. I got futures flat here right now. The VIX 14.45. Euro's what John and I are watching. Euro dollar 107.06. Off of the Williams confab yesterday was a really important seminar. My final question to Christina Campmany of Invesco, Lee Farage of State Street, and one Torsten Slok of Apollo Global Management was on Williams R-Star. Torsten, I was absolutely thunderstruck by the responses. Campmany out at 4%, Lee Farage in a 3 handle, and even you going all unanchored on Williams and suggesting we go from this 2% nirvana up to something higher, under 3%, but something higher. How does our world change if we get a new interest rate regime out there somewhere?
Well, I do think a very important implication is that then the cost of capital will be higher. The cost of capital will be higher for companies. The cost of borrowing for consumers will be higher. And all that will, of course, imply that we're going to have more of a significant impact, at least in the near term, on not only consumption, but also on corporate spending.
Through price, do we see asset price reduction because they got yield up, price down in a simplistic way?
Yeah, because your equity risk premium model, if you change the risk-free rate and you permanently increase that for whatever reason, demographics, energy transition, less immigration, whatever it might be, if you have the discount rate going up in any finance model, on page 1 in your textbook would tell you that then risky assets are going to become less attractive relatively.
This has been a fascinating week because we've seen the fastest pace of issuance this year when it comes to investment grade bonds, the 3rd busiest post-Labor Day couple of sessions going back to 2010. Companies are saying, okay, rates are going to be higher for longer. We're going to sell debt because you know what? We're going to have to just absorb these higher costs. Isn't this a positive sign that they're actually able to absorb these costs and able to access the credit markets and things keep going even if at a more expensive rate?
Well, I mean, broadly speaking, of course, September is mainly having a lot of issuance because the summer normally has relatively low levels of issuance. So first, there's a seasonal issue why issuance has been so high this week. But the other issue is also that, well, we're at the same time in the background seeing that the high yield default rate is actually moving up quite quickly in the last 6 months. We're now, at least on the Moody's default rate, we are at around 4%. And if we keep rates at these levels, you know, every day on the Bloomberg terminal, you see stories about their companies that cannot get a new loan, companies that cannot roll over an existing loan, in particular for lower rated companies with higher leverage, and especially when it comes to interest coverage ratios. Interest coverage ratios, which measure earnings divided by interest expense, is coming down both for IG quite quickly and also for high yield. So it is not the case that all firms just have locked in long duration of lending. It is the case that we are actually seeing interest coverage ratios going down both for the IG and high yield index.
This is fascinating, the spike up that we're seeing in high yield defaults, albeit from really low rates and albeit still at historically low levels. When you pass that out, or you basically model the next 6 months, the next 12 months, do you end up with an acceleration of these defaults, or does it kind of plateau? Are we seeing the pain now as some of the rate hikes come into the market?
Well, this is really important because so far, the soft landing argument is that it has been very orderly, the slowdown in the labor market. It's been very orderly, the slowdown in inflation. So what's the problem? Well, the problem is that in the background, if you have this increase in default rates, especially in high yield, and remember the high yield industry basically has employment of roughly 11 million people in the economy, so it's not small. So the conclusion is if high yield default rates are going to continue to move higher because companies cannot get financing, well, then the effect will be that maybe at the moment, these are names that many people tell me, oh, we haven't heard about. Well, just wait until you get a default in a name that actually everyone has heard about. Then that industry, that rating, that type of interest coverage ratio, that type of leverage is going to be much more vulnerable. And that could change sentiment potentially quite quickly, in particular in high yield, but also in IG.
And just across the board in terms of what kind of rate structure is going to be important going forward, as we were hearing from Stephen Major of HSBC in particular, that catalyst event. From your vantage point, how does this play out? The bear case, is it some sort of deep recession? Is it some sort of fissure in the credit markets? Or is this just a recession, the one that everyone was calling for earlier this year?
So I do think that it will be a continuation of what we're seeing. The Fed, the ECB, they are stepping harder and harder on the brakes. And this is not just about the change in interest rates. This is about the level of interest rates. And as that process continues, if you on your Bloomberg screen type ECFC go, have a look at what non-farm payrolls are telling you about Q1 of next year. The consensus is expecting that non-farm payrolls in January and February and March will be 12,000. So you now lean back and say, well, if we're getting non-farm payrolls in 6 months, that will be close to zero for 3 months in a row. How do you think risk will trade on that? And if that process of slowing the economy down as a result of the Fed having raised the cost of capital continues, we should expect to see an ongoing slowdown ahead of us. And I do think that ultimately that will create a risk of a harder landing.
In the last 18 months, coming out of COVID, with all the original economic framework that we have, the supply shock, et cetera, we've had so many things wrong. We got the recession wrong. We got, before that, transitory wrong. We got 4 other things wrong. The Red Sox, we thought they'd, have a good year. It didn't work out. And Harry Kane would never leave Tottenham. What right now that's a consensus call do you think we're going to sit back a year from now, 18 months, and go, God, we got that wrong?
What I think is truly fascinating is that we did go into this year, all of us, expecting a sharper slowdown than what we saw. Yeah. And because of excess savings in the household sector, this just took a longer time. More people have been traveling on airplanes, staying at hotels, eating at restaurants. The service sector, which makes up 80% of GDP, has just been a lot stronger. So it is a bit ironic that this process of slowing things down has continued. The Fed has kept on raising rates. Cost of capital continues to go up. Delinquency rates for credit cards and auto loans continue to move higher. And just as all these things finally started appearing, everyone said, well, now we're not going to have more of a slowdown. Now it's just Goldilocks and we'll have a soft landing.
So you think Goldilocks right now is the thing that we're getting wrong?
I do think that the risk is that this process, remember, think about what the Fed is doing. The Fed is raising interest rates because they want us to spend less money on our credit cards. They want us to buy fewer cars. They want us to buy fewer homes. That's the whole idea with slowing things down.
Off of Jonathan Spence's classic work, in Orville Schell published, I believe it was in the Telegraph, I stand corrected if that's wrong, Orville Schell writing on China. What I'm getting out there right now basically is a death of China. All my radars up, Torsten, and you wrote on it this morning.
That is a major risk, and the Fed had a working paper a few years ago where they tried to quantify what is the impact on the U.S. of correction in Chinese GDP, and they found a relatively modest impact, that a 1% decline in GDP only had a 0.2%. In China, had only 0.2% impact on the U.S. But this is now to be tested because China is not only slowing for cyclical reasons, meaning exports are going down because U.S. is slowing and Europe is slowing. They also have 2 other issues, namely the housing situation is getting more serious, and on top of that, they also have the demographic situation that's getting more serious. So all that combined is generally going to drag down GDP growth in China and also have implications in particular for Europe, but also for the US.
But just one of the big counterpoints to the bearish argument that you're making is that growth has surprised to the upside, and it continues to, albeit at a slowing pace, and that companies are still doing well. How do you understand that surprising resilience?
Yeah, well, the nuance to that is that growth in employment has continued to slow down. And also when it comes to, are companies really doing well, but why are default rates then going up so much? Why are interest coverage ratio going down so much? All these things that credit conditions are tightening in the background, interest rates are essentially, as the Fed wanted, biting harder and harder on consumers and biting harder and harder on corporates. And combining that with student loan repayments coming back and also households running out of excess savings, at least according to the San Francisco Fed, you can begin to worry about the next few months having a continuation of what the Fed wants to see.
That's a Slockian gloom.
Well,
but seeing the slowdown continue going ahead.
What would you have to see to change your view?
So what we need to see is essentially the cost of capital coming down, because the first domino brick in this process of the data that we're all watching across the board is that the Fed has raised the cost of capital. And as Tom was saying, maybe there are some reasons why the cost of capital might now be permanently higher. And the fact is that all this higher cost of capital is having an impact across the board, in particular consumers, corporates, but of course also again on high yield default rates moving higher.
Torsten Slok with us, so we're going to continue here right now. We've got 2 data points here. Let me tell you about the Standard & Poor's 500, a bit of green on the screen, up 0.1%.
Torsten Slok is presenting the bear case here, and I do have to wonder, Tom, how much pushback he gets from people who are sick of being wrong with the recession calls of earlier. I see a lot of potential pushback. I'm curious what that is.
Can I translate that? She sees a toxic brew up there. you see a toxic brew up there?
And people push back against it.
No, I think as an investor, let's summarize what this means for investors. It basically means that if we weigh the risks up on the scale, then the risks are still that the list of bullet points to the downside continues to be fairly lengthy. So that's why, yes, true, it could be that excess savings can last a little bit longer. It is also true that we could get still a little while longer, that things are okay. But the bottom line is the Fed wants to slow things down. Don't fight the Fed.
Right.
And with that, we should continue to see things slowing down.
Let's rip up the script here. Looney just exploded. Schatzker did it. Schatzker's conversation with Trudeau. We got strong Canadian dollar. No, pushing against it. And once more, Lisa, this really dovetails in with your observations here. Canadian dollar extends gain after jobs report beat in Canada.
And wages
Trudeau
accelerated.
on his way to India is going, yeah.
Is he, though? And this is sort of the
Crack open all the
question.
bats.
Maybe, and wages accelerating. But again, does this play into, well, something else is going on here? Again, it's just the confusion. It's a swirling, toxic confusion.
Toxic brew. Torsten, but this goes to the surprises out there and the resiliency that we see. We're going to run out of time here, Torsten, but we got to get you back on this. I think that there's any number of ways to slice this. Folks, it's extraordinary. What can I say on a Friday? Good news from north of the border. Futures up 1. They explode higher. The VIX 14.38. Canada, there it is. Looney 1.3609. Stronger Canada.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
China's not going to go away. China's always going to be here on this planet. The U.S. isn't going away. We're always going to be here. It's kind of like an arranged marriage. It's not a marriage based on love. We don't love each other. But it's an arranged marriage where we have to learn to accommodate each other. And I'm hopeful that that's at least going to begin to be one of the results here.
Relationship counseling with Max Baucus, former U.S. ambassador to China, talking about how both nations exist. They got to work together to some degree. Not working together, though, right now, Tom, giving some of the tit for tat that we keep hearing on both sides.
81 years old, Max Baucus will forever be 50. He is so vital. He has so much energy. He's been a public servant of the nation out of Montana, and then he did a tour of duty in China, and this guy's authoritative. It's like Mike Marshall from years ago in Japan. I mean, Max Baucus has an understanding of China like nobody to beat the band.
So does Anna Ashton, who's coming up with Eurasia Group. But I do want to just give you a sense of why we're so focused on China. Apple shares very much front and focus after 2 days of losses of more than 6%. They've turned up, which is interesting.
Exploded
the buy, the
higher.
dip, maybe maybe the Anastasia Amoroso view of things taking over up 0.3%, also up, and this is interesting, Ford and GM shares, both up almost 2%, even with that looming potential default on September 15th by the UAW and the offer from General Motors of a 16% pay rise, of the offer, just actually not even the offer, the Ford. What?
I mean, you said a default. It's a strike. We don't call it a strike. We're going to go on default. We're going to go on default. I like that.
All right.
Elegant.
Well,
it's more elegant.
Thank you. Well, defaulting on showing up, it's basically...
We're on the picket line defaulting.
Okay, moving on. Thanks for calling me out on that, Tom. I know I can count on you, but there is going to be a question here about whether longer term there is going to be some ramifications, or this is just the market gaming app, that they're going to get to some resolution ahead of that time.
I am in the camp with Goolsbee of Chicago. Does he speak today? That Goolsbee is right. It matters. I'm old school enough.
Totally.
I'm sorry, it matters. And
well,
we'll see.
By the dip, though, coming back a little bit, and some of the names that have gotten most, just gotten a lot of attention recently. Not a lot of action today. I think people are exhausted. It's been a weird month.
It's been a weird month. It's been a weird after Labor Day start to the week, and it gets weirder next week. Stay with us next week for a huge news flow. I can't say enough about the news flow anticipated next week, and then we will be in London looking at the huge challenges post-ECB of what we'll see from the continent of Europe, and of course the unique challenges of the United Kingdom, including Harry Kane going to Bayern Munich. That'll be, we're going to devote, I think it's Tuesday, we're going to devote the entire show to the exit of Harry Kane.
Can't wait.
To Germany. Right now, working with Ian Bremer at Eurasia Group is Anna Ashton, Director of China Corporate Affairs, on, of course, this relationship of U.S. and China. We need a brief this morning as well. And I'm going to cut to the chase. I see a lot of hysteria, and we've had some good voices calm us down a bit. Take us away from the immediate hysteria of China to clear thinking. How are you thinking clearly about the domestic challenges of China?
Well, Tom, it is quite a challenge to be the one who's supposed to come up with the positive take, because China really is facing some serious economic hurdles right now, and they're different from hurdles in the past. The slowdown is systemic. The real estate crisis is affecting lots of sectors, but at the same time, it is important to remember that while China may be growing at this present moment more slowly than the United States, which is odd, and it's still growing. And it is an enormous country that is also growing in population with a middle class that is set to grow. So there's a ton of opportunity that remains. I think one of the issues that is kind of separate from the slowdown, but also makes it harder and harder for foreign firms to do business successfully, and has nothing to do actually with regulations either, is just the fact that there's more competition in the Chinese market from domestic companies than there used to be.
If I look at the domestic companies, it comes back to the SOEs, the state-owned enterprises. Like the waves every 8 years, we're going to de-emphasize them, we're going to re-emphasize them, or that. What is the relationship of those state-owned enterprises now with the new Xi regime in Beijing?
Well, definitely Xi Jinping is more of a state sector man. He has definitely moved away from his predecessors in re-emphasizing the role of the state, and in his pretty firm belief that the state needs to be involved in directing which parts of China's economy are going to be emphasized and are supposed to grow. But interestingly, that seems to be the direction that U.S. politics is going to a lesser extent as well.
Anna, we had Pierre Ferragu on earlier, and he was saying that he wants to start it, or he wished he had started a hedge fund to buy every dip in some of the names that are most affected by the geopolitical headlines, in particular about U.S. and China relationships souring. Is this time different?
On the one hand, I would agree with him. How many times has there been a prediction that China was the coming collapse of China, that China had reached the end of its miracle of growth and development? But So I tend to err on the side of China will figure it out, because there have been all of these times in the past when we thought it was different too. But there are some serious differences here. A big one is that there's really no way for China to try to come in and bail out the economy and rescue growth with a huge stimulus the way it has done in the past, without reinflating the real estate bubble. And if they did come in with a stimulus, it wouldn't necessarily do what they truly need it to do, which is increase consumer and private sector confidence so that there's more consumption. And that really is a change.
Do you also think, Anna, that there needs to be, or that there will be, more of a response from the U.S. in light of the fact that the new development in the Chinese phone was released during the Commerce Secretary's visit to China? Gina Raimondo is there. The timing very much trying to thumb the nose at the U.S. government, and that there seems to be a much more direct tit for tat.
There's definitely a much more direct tit for tat. And, we've seen that play out in a number of different forums in the last few days. So there was Gina Raimondo's statement on Face the Nation about not necessarily wanting to apply the word trust to the relationship or improved trust after her visit, but saying, we really need to see action. And there was, sort of similar tone from Vice President Kamala Harris when she was at the ASEAN Summit and the East Asia Summit, talking about the need for China to not pursue these gray zone activities in the South China Sea. Sorry, go ahead.
No, thank you, and I greatly appreciate it. Too short a visit today. Let's do it again. Somehow we will with China. So much in the news. Anna Ashton with us with the Ian Bremmer's Eurasia Group. I'm going to bring this back to G20. I believe Justin Sink is on the plane with the president. We're going to see the president land here. I'm going to think within 30 minutes nighttime in New Delhi, and of course all of our coverage there. I thought Manana was wonderful earlier this morning. I want to go to Dr. Bremmer, working with Anna Ashton, and is a wonderful effort. A G0 world. I wonder, is it a G0 G20 this time around? Because selected people aren't there. There's sort of this massive confusion. And oh yes, there's a war going on as well. I have no idea where we are on the backside of G20, or frankly, if it matters.
Well, and that's the communique that we've gotten some sort of indication that they've already drafted, talking about risks to long-term growth from cascading crises, which means basically, we don't know. We're worried too. I mean, really, what kind of communique is this with any definitive response to what's going on? Unclear. The more interesting part of these meetings, to me, will be the side conversations. Saudi Arabia's Mohammed bin Salman with President Biden, the Prime Minister Modi with President Biden in terms of creating a closer tie there. Some of these sort of geopolitical fault lines where they start to emerge in a more concrete form.
This goes back to Obama and the Pittsburgh meetings, where maybe they actually got something done a zillion years ago. But, the bottom line is I look at the G20 meeting less of a G0 effort than the G7 meetings or the G6 meetings. I think, as you say, these bilaterals that they have off to the side can be actually more interesting. And, you show up, the elite meet to greet to keep the dialogue going, which maybe right now is not the worst idea.
You think Tim Cook's going to show up? Be like, hey, just want to chat with you.
He's G21.
Exactly.
Yeah, I like that. We've coined that. Bramo gets a copyright on that, folks.
Right.
Tim Cook, Apple joined, that's the headline, folks. Apple joins G20 to make it G21.
Just to be clear, we have no confirmation of that. So if you think that, that's not.
It's speculation.
Oh, is that?
Here
yeah, speculation from us.
Future's flat. Mohammed Alarian's writing it down. Make a note. Bramo says it's G21. Alarian in the next hour with Farrell. That'll be interesting. This is Bloomberg. The G21 coverage.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
3-day losing streak on the S&P 500, attempting to make sure that it's not day 4. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York coming up. Apple in some pain ahead of next week's launch. GM's 16% pay raise offer quickly slapped down as Goldman is gearing up to cut underperformers. We begin with the big issue, rate hikes on ice.
The Fed's on ice. Probably pause.
Press the pause button.
The pause in September.
Pause and wait a little bit.
Unless you got something very significant on CPI, I think they're not going in September.
The real debate amongst investors is whether the Fed goes again later this year.
Does the Fed go one more time? The question will become the November meeting. They're going to want to keep November in play.
If you look at the labor market, there is an argument to go stronger, and there is an argument to pause.
The job market is starting to weaken in a lot of ways.
These cracks are forming.
If you look at claims, you'd think the economy is on fire.
The Fed's job now is much more complicated.
There's a lot more data between now and the end of this year for them to think about.
Does inflation continue to soften into the end of the year, or do we get a rebound?
Where does inflation finally go? We'll have to see how the data plays out.
The data is next week. Joining us to discuss, I'm pleased to say, always a pleasure, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's start there with the Fed in a few weeks' time. Are rate hikes on ice, and can CPI next week change it?
So CPI next week can definitely change it, not September, but can change the next rate hike at the end of October, beginning of November. John, there are bigger issues here. I think the discussion is going from whether they will hike or not to what's the overall impact of the level of interest rates. There's also now more discussion of how high, not how high, how long are they going to stay there? And underneath all that, John, are some really challenging technical issues about monetary policy. Everything from R-star to, what are the real lags in play. This is a very complicated time for the Fed, and markets should not jump to conclusion too easily as to what's going to happen beyond September.
Speaking to those complications, Mohammed, some contradictions in the economic data this week alone, and maybe you can help us. Jobless claims at the lows we haven't seen. Mohammed, some contradictions in the economic data this week alone, and maybe you can help us. Jobless claims at the lows we haven't seen since February. The ISM was pretty punchy. The beige book screams slowdown. I've been asking all week, Mohammed, I'm sure you've heard me ask it, how much weight should I put on each data point that's coming out at the moment? What's given me a clearer story of what you think is happening?
So I think the consistent story, John, is that services are strong. And they are strong in employment, they are strong in wages, they're strong in output. And that is a very important thing to focus on. Beyond that, you have massive ambiguities. Beyond that, you have also the dependence on the rest of the world, which is in a very different place from the US. So I think the key issue is get services right. And if you get services right, you can explain much of what's going to happen going forward. But there are other issues that are going to become more important as we go deeper into 2024.
What do you think those issues are, Mohammed? What's number one for you?
So it's the supply side, John, and the way it plays out, whether it's labor negotiations, whether it's the price of oil staying so high when Chinese demand is under pressure, whether it's what's happening to Apple in terms of geopolitics and what that does to supply chains and what does that to demand chains. There's a lot of aspects, but supply is the number one. We've transitioned from a world of insufficient aggregate demand to a world of insufficient aggregate supply. And that's going to play out for not just 1 year, but for a number of years.
We talked about crude earlier this week being at highs we haven't seen all year, back to November, $90 on Brent. Mohammed, if we just looked at that one commodity, I'd be with you. I'd say that's just a supply story. The Saudis, Russia pulling back. But iron ore's in the mix as well at multi-month highs. We just talked about the contradictions in the US data. Let's talk about the contradictions in the global story. We're told slowdown in Europe, we can see it. Slowdown in China, we can see it. And then I see commodities where they are, Mohammed, and I'm trying to reconcile those two things. Are those two things competing with each other for you?
So once you go beyond the supply story, it becomes very specific. You can explain a lot on the supply side. You didn't mention food, but food prices have picked up again. So there is a lot to be explained by the supply side. But then if you go to individual commodities, you will have other factors playing in. John, I mean, for me, there were three big surprises in the first 8 months of the year. 2 positive, 1 negative. The negative we know is China. The positive we know is the US, but also Europe was better than many expected. Going forward, China doesn't recover. Europe doesn't maintain a positive surprise. It's all about the US when it comes to global growth.
Well, let's take that story, push it through FX. You know where we've got stronger dollar, 8 weeks of it, 8 consecutive weeks of dollar strength. Is that because the US is just so great right now, or the rest of the world, Mohammed, is so bad?
It's both. It's US exceptionalism in absolute and relative terms. That results in rate differentials. That results in flows of foreign direct investment being even more concentrated in the US. It is all about relative and absolute US exceptionalism.
Well, Europe's in a dark place going into the ECB next week, Mohammed. Can you speak to me about the inflation growth mix you'd expect to see from Europe over the coming quarters?
Yeah, it's tricky, John. I mean, if you're worried about stagflation, it's Europe and it's the UK where the threat is highest. And it's a really tough situation for the ECB. If the ECB wasn't a single mandate central bank, they probably wouldn't hike. I've put a 55% probability that they end up by hiking, but it's that close, John, as to whether they should hike again.
Split right down the middle. There are things that Fed officials can say right now that ECB officials cannot say. We're in a good place. Mike McKee caught up with John Williams in the New York Fed. Take a listen.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do.
Mike McKee, are we in a good place?
We are in a good place. If the Fed could design where it wanted to be with its policies, this would probably be it. They don't know exactly what's going to happen, but right now they've got low unemployment and inflation that's going down. John Williams, in terms of the September meeting, put the nail in place. Lori Logan from the Dallas Fed hammered it home last night, giving a speech, and she's the most hawkish member, pretty much, of the Open Market Committee at this point, saying another skip could be appropriate, but caveats that with skipping does not imply stopping. So I think what you're looking at here is definitely pretty much everyone in favor of skipping in September, maybe Mester and Bowman. We got the sorting hat out now that we're heading into the final week before the Fed meeting and the quiet period. And you can see on the left-hand side and in the center, there's a majority who've said we can skip this time. Not everybody thinks they should skip in November, but you go on to the calendar and you see what's up next week besides CPI. There's a lot of data coming in that could weigh on them, but I think Mohammed said something very smart. The CPI is probably going to affect what people think of the November meeting rather than the September meeting, in part because economists are pretty good at forecasting CPI, but in part because so many Fed officials have already set the market up to get through the September meeting without a move. But watch retail sales. And of course, the big question next week is going to be whether the UAW goes on strike. That would have a significant impact on the economy, probably short-lived, but we'll have to see. And that is the big wild card for next week, along, John, with the hurricane that may or may not come.
I've seen some of that. That does not look good. Mike McKee, thank you, sir. Looking ahead to next week. Mohammed, Mike talked about it. You mentioned it in the last 5 minutes. These labour debates, unions, the Detroit Three and UAW. I've asked this question this week. I'll ask it of you, Mohammed. Do you think that's the dying embers of a hot labour market, or maybe the story that's going to stay with us for a while?
It will stay with us for a while. This is an indication that labor has more bargaining power. It has taken decades, but labor has restored some of its bargaining power. And you see this not just in the US, you see it elsewhere as well. And that's another supply side issue. John, can I just say something? Mike McKee's interview with John Williams was excellent. His mention of what Lori Logan said was really good, but the quote that really hit me from her last night was when she came to talk about what approach she needed on monetary policy. And she said something like, we need a very calibrated approach as opposed to, quote, throwing buckets of cold water on it. And I think that that is critical going forward, is what does calibration mean? We're no longer in the phase of catch-up where you made a mistake, you called it transitory, and you have to rush. Now it's really back to old-fashioned calibrated monetary policy. And that gets a lot more complicated.
Let's get away from the last month or so, looking ahead to the next month, Mohammed. Let's talk about the complications of maybe the next several years. There was a headline from our reporting on the G20 of a draft of their final communique, and it read as follows. The G20 sees a challenge to long-term growth from what they called cascading crises. And right in that moment, Mohammed, I read that headline and I thought of your book coming out, Brown, Spence, Salarian, A Plan to Fix a Fractured World, Perma-Crisis. Mohammed, can you breathe some life into that conversation? What is it that you and Gordon Brown and Michael Spence see that maybe speaks to what the G20 are talking about this weekend?
So that book originated from Zoom calls. The three of us had weekly Zoom calls. And after a while, when talking about going from crisis to crisis over a number of decades, we ask ourselves why. And basically it comes down to three issues, John. We haven't figured out a way to grow in a high, sustainable, and inclusive manner. So it's about growth models. Domestic economic policy management has been lacking. That's a second issue. And global coordination is at the lowest level that the three of us could remember for a very long time. So we asked the question the other way, is if you want to get out of this notion of cascading crises or perma-crises, what do you do? And we wrote down basically a plan to fix all three.
Looking forward to getting my hands on the book, Mohammed. Should we finish with an easy question? Jets, Bills, Monday Night Football. I had to zoom in and see the tie, the Jets tie this morning. Mohammed, what are you looking for from the team this season?
I'm hoping for a good season, but I tell you, our first 6 games, including Mike McKee's Broncos, are quite tough. So fingers and toes crossed, and as I'm wearing the tie, us Jets fans, us long-suffering Jets fans will do whatever it takes and whatever we can to support our team.
You were slightly critical about taking on Aaron Rodgers. Do you still feel the same way?
Look, John, it's done, so we're fully behind the team now.
Mohammed, thank you, sir. Good luck for the rest of the season. We'll catch up with you soon, no doubt. Mohammed Al-Arian on a bunch of issues looking ahead to next week. More still to come. We're about 20 minutes away from the opening bell. Your equity market is unchanged. It's dead flat. Let's get you some movers. Here's Abby.
Well, beneath that flat surface, John, we do have quite a few stocks moving a bit to the downside. Let's start out with the shares of RH. They are falling down 8.8%. Now, interestingly enough, the quarter was decent. There was a massive adjusted earnings beat. The revenues beat was also strong, but it's the guide investors, analysts, and traders are worried about. The third quarter revenue midpoint misses. The company is cautious on economic challenges, and one analyst saying that the guide simply was not good enough. As for Kroger, down 1.6%. A mixed quarter. They beat earnings, missed sales. The second half view a little light. Now, Kroger and Albertsons, they're selling 413 stores to C&S for $1.9 billion. That was also a piece of the information that came out this morning. And they're also saying that their merger is on. As for Apple, well, John, we finally have a bit of a reprieve here. A small gain up 0.5% after a 6.4% two-day tumble on the China banning the use of iPhones in certain settings. At the lows, down 8.5%. At that point, John, that selling was the most intense we've seen since September of 2020. It's going to be interesting to see whether or not this small gain in the pre-market can hold.
Abby, thank you. Coming up on this program, Huawei dropping a smartphone upgrade just as the G20 commences in India.
China faces a variety of both short and longer-term global challenges. I don't see it as having very significant direct impact on the United States.
The latest on US-China tensions up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
China faces a variety of both short and longer-term global challenges, economic challenges that we've been monitoring carefully, including less of a pickup in consumer spending than had been anticipated. China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
Secretary Yellen at the G20 summit weighing in on China. President Biden expected to arrive in New Delhi this hour amid simmering tensions. Air Force One just touching down in India right this second. China planning to expand its iPhone ban to state companies and other government-backed agencies. The US kicking off an official probe into the chips used by Huawei, just as the company debuts a new and more powerful phone. Your team coverage starts right now with AMH and Kelly Lights in Washington, D.C. Anne-Marie, looking over to India, what are you expecting?
Well, this is really the U.S.'s chance, with both Xi Jinping and President Putin not there, to make sure that they're garnering the support of the developing countries, the global south, that has been put in a predicament with this war. Remember, India has walked a really fine line, at times not even being able to call it a war. So, Jonathan, when it comes to the communique, the bar seems very low. For some in the West, it was a low one they were able to clear at the G20 in Bali, when they were able to say that most members condemned this Putin's invasion of Ukraine. Initially, China wanted to get rid of it at this summit, but it looks like they are dropping that. But that will be one of the bars to clear. The other, of course, Jonathan, is a lot of this is going to be about what the West can do for the global south, what they can do in terms of development funding. The U.S. is really going to want to talk about funding for the World Bank. And for them, they're really trying to outline, you can still stay with us, we will support you, and this is an alternative path to Beijing's Belt and Road.
Xi Jinping will not be at this G20. Katie Lyons, I just wonder if these are coincidences or not. Gina Raimondo, the Commerce Secretary in China, Huawei unveils a new phone. G20 is just about to start. They unveil an even bigger new phone. What's your take on this, Kaylee?
I don't know if I can draw any firm conclusions, John, but the timing certainly is interesting, or at the very least, a very strong coincidence that this would be happening. Really speaks to just the tit-for-tat relationship and how it's one step forward, seemingly two steps back in a lot of U.S.-China relations. On the subject of this new phone, which is, of course, revealed just a week after they initially revealed the Mate 60 Pro, it really is the chips that are of concern to the U.S. here. This includes an advanced made-in-China chip, a 7-nanometer made by SMIC or SMIC, which of course is the Chinese chip maker. It also is under restrictions in the U.S., restricted from accessing American technology, just like Huawei is. And Huawei has literally billed this phone as a sign of a triumph against U.S. sanctions. So now the U.S. government has actually launched an investigation into this purported chip to see whether or not the restrictions that have been put in place have failed, or maybe they need to be tightened. You have the likes of Congressman Mike Gallagher, who chairs the China Select Committee in the House of Representatives, who is saying that they may need to end all exports to both Huawei and SMIC. China, for its part, though, countering that, a spokeswoman for the foreign ministry today, saying sanctions will not stop China's development and will only strengthen China's resolve and capability to seek self-reliance and technological innovation. And of course, speaking of interesting timing, John, all of these developments in regard to Huawei's smartphone are coming at the same time that Bloomberg is reporting that the Chinese government is looking to restrict further the use of iPhones for government employees, potentially state-backed agencies and other state-owned entities, as you were referring to. So it speaks to potentially a kind of smartphone war developing in the Chinese market, which is very important, as we know, for Apple.
Just a week away ahead of that new iPhone. Katie, thank you, alongside AMH down in Washington. Joining us now, I'm pleased to say, Binky Chada, Deutsche Bank, Sarah Hun, Alpine Saxon Woods. Sarah, let's start with Apple. If Apple, with the diplomat Tim Cook at the epicenter of that company, is in the crosshairs of tension between the US and China, who else is the Sarah?
Well, I think that this is a problem for the entire supply chain, right? Because on the one hand, you want to restrict technology because you don't want the things that we're trying to avoid. On the other hand, we're selling it to China. It's a big market. So there's a lot of tension here. And the supply chain, you can see that some of the suppliers got hit yesterday, too. And the question of whether or not they can start to develop their own chips also is a big question and a problem at the moment for Western companies. Although eventually, all those things will sort themselves out. But right now, it certainly seems to be in the crosshairs.
Binky, two issues in China right now, two dimensions, regulatory and growth. For multinationals, throw in a third aspect, a stronger dollar. How challenged, Binky, are some of those multinationals listed in America with exposure to those things?
I'd say a little vulnerable. I would say, as you put it, there's the cyclical and there's sort of the longer term and structural. I would argue, on the cyclical side, we sort of remain constructive that, the recovery is happening. It's happening a little bit slower, but it's certainly not sort of, a situation where the bottom's falling out. And there's, from a cyclical point of view, reasons to be constructive. And so I would see a pickup. Now, as far as the structural issues are concerned, I mean, they're clearly negative, but I would say, they take a long time to play out. And in the meantime, in the near term, it's really more about the cyclical. And I think the cyclical, it looks to us like it's going to be okay, is the way I would put it.
Binky, I've got a bit of time with you around the opening bout, you and Sarah. There's a big question for me, and it's actually born out of your research, Binky. I'm going to ask this question. The earnings and macro cycles. Binky, just give me the tease. We can have a longer conversation in a moment, but do you think they are unsynchronized at the moment?
Well, they're not unsynchronized in the following sense, and that is that what we've gotten on earnings is a reality. What we've gotten on GDP or other macro indicators is also a reality. And what those two realities are both saying, especially earnings, is that the bottom in earnings was in the fourth quarter of last year. Yes, we had 2 quarters of negative growth. But this year, what we've seen is basically a very strong recovery. When you look at earnings, the same way that we look at macro data, which is sequential, quarter on quarter, and of course, seasonally adjusted. We had 3.5% sequential growth in the first quarter, very similar in the second quarter, and looks like it's going to move up in the third quarter. So that's basically saying that, the recession or the slowdown, a mild recession slowdown, happened basically last year, and what we are seeing now is basically the recovery. Now, the disconnect or asynchronization has to do really with the consensus forecast, which is still for, a very, very sharp slowing in growth.
We'll discuss that recovery, Binky, in just a moment. Binky Chadha, Sarah Hunt, the President of the United States, 6:55 in New Delhi, India, touching down for the G20 this weekend.
Of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Let's get you some morning calls. First up, Deutsche Bank upgrading First Solar, growing increasingly confident about the company's margins. BofA upgrading Gilead to buy, highlighting its underappreciated pipeline. And finally, JP Morgan cutting Apple, the price target to $230, seeing limited upside due to mounting China headwinds. Up next, Dan Ives of Wedbush, why he thinks the latest Apple news is nothing more than loud noise.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Three-day losing streak on the S&P 500, down around 1.5% over those 3 days, and looking at a weaker losses on the S&P. Futures right now almost totally unchanged. On the Nasdaq 100, just a little bit softer, difficult there over the previous 2 days, with Apple down more than 6%. There's your opening bell. Switch at the board and get to the bond market. Yield shaping up as follows on a 10-year, down about a basis point. Your yield, 4.23. Your euro, a break of 107 in the past 24 hours. Had a little look at 106 again this morning. 107.11 right now. That currency pair positive by 0.1%. And what a run for crude. WTI, 87. Handle $87 and close to 10 cents. We're up this morning by 0.2%. About 20 seconds into the session, we are dead flat unchanged on the S&P 500. Similar story on the Nasdaq. One stock to watch at the open. It's Apple. Looking to snap a 2-day losing streak that's wiped out nearly $200 billion of the company's market cap. JP Morgan expecting recent developments to continue weighing on shares, writing this. Outperformance in the second half is unlikely now, given its premium valuation and mounting risks in China. Ed Ludlow has this one. Morning, Ed.
Yeah, good morning, Jonathan. We are rebounding this Friday. Apple up 0.8%, following a 2-day decline Wednesday, Thursday that saw the company shed around $190 billion from its market cap. Apple has its iPhone 15 launch event next Tuesday. I will be there with Bloomberg Technology, and it's interesting because if you read Mark Gurman's reporting about what to expect, it's the latest proprietary silicon that goes into those iPhones, 3-nanometer A17 processor and U2 RF chip. Those are the things to watch. But in the context of what we learned this week about Huawei, the potential of the Mate 60 Pro by Huawei to take on Apple in that market, we know that Huawei is 2 generations behind, irrespective of what happens with the US investigation into its chip. You cited the JP Morgan note. I'd note that Citigroup also has a note out with a similar tone, that the news flow and indeed the competition from Huawei's Mate 60 Pro in China could weigh on the stock going forward. It could impact the market there. And I'm sure you've had a range of conversations on the open this week. We have on Bloomberg Technology that no one really agrees what's going on between the US and China, whether it will impact Apple's growth in that nation, in that market of greater China going forward. I just remind you what we discussed yesterday, that in the June quarter, Apple swung to top-line growth in China of 8%, and what was the catalyst for that was people switching to the iPhone or buying the iPhone for the first time in China. Maybe we'll get a sense if that continues, if the hardware upgrades that are coming next week in the 15 are substantive enough.
And I've got that note from Citi. Work with me here. I'll read out some of it for our audience. This is what they've got to say. We view the recent news flow around China and Huawei's latest launch as a headline risk for the stock, but the analysts reiterating the buy rating and closing out the upside catalyst watch on the shares, whatever that means, ahead of the launch next week.
Yes.
Within that note, I think this is interesting and it's important regarding Huawei. Citi say this about the Mate 60's technology, still 2 or 3 years behind, and raise an important question that I'm going to talk to Dan Ives about over at Wedbush in a moment. Limited production capacity. Does it really have the mass, the scale to compete with the likes of Apple and the iPhone 15?
So, exactly so, John. So there were two big stories this week in simple terms. The first was the Chinese government telling government employees and state-owned enterprises to move away from the iPhone and use a domestic handset maker. What impact will that have? We don't know. That's where we're undecided. Huawei unexpectedly bringing out the Mate 60 Pro, it sold out and ran out of inventory within hours. And so the analyst that Bloomberg have spoken to says that indicates limited volume, but by extension indicates that even with 7 nanometer nodes, they are still not at volume. 7 nanometer is 2 generations behind the chip that Apple will put in its iPhone 15 to be announced next Tuesday. So there is not just a technology gap, but Apple clearly has a volume technology lead that the domestic players in China have not yet got. And even if Huawei can turn to a domestic name like Semi Manufacturing International or SMIC, they're not at a place where they're building at volume. And so the availability of that handset, per the note you just cited, seems limited.
Ed, stay close. We'll talk about it again in about 10 minutes' time. That stock is rebounding by 0.9%. Rough couple of days for that name. Rough start to September. NVIDIA looking to turn things around with a partnership with Reliance to develop AI infrastructure in India. The CEO slating India has scale, data, talent. Reliance can build its own large language models that power generative AI applications. Abby has more. Hey, Abby.
Hey, John. And yet, well, right now we have NVIDIA trying to flip positive. I would say that this news is a positive, more so for Imbue as opposed to NVIDIA, because when you think about it, they're a part of a $200 million investment in this AI startup. They have a greater than $1 trillion market cap. So it's a very small investment for them, but nonetheless to create AI agents capable of reasoning. And the goal is to make users more productive. But what we really have to take a look at here, John, is the month of September. The last 2 months of September for NVIDIA have been very rough. Last year, down 20%. The year before that, down 7.5%. This year is no exception. Right now, we're down 6 to 7%, the worst month of the year. And this also is the second big decline in just a couple of months. If you recall, they put up that blowout quarter, and instead of doing what happened back in May, where the stock just absolutely rallied to new record highs, it gave back 10% of that. So now we have a double decline, having everything, of course, to do with this year's monster rally, up 220%. Interestingly, because the numbers have been so big recently, valuation, for the first time that I can recall looking at, doesn't look ridiculous. They're actually trading at a small discount on multiple metrics to their peers. Something I would point out, though, John, there's a huge air pocket on the chart between about 300 and 400. Typically, those tend to fill. It would come on some big fundamental reason. It'll be interesting to see if and when that happens, John.
Abby, thanks for that. Let's get an update on the auto sector as well. GM has made a counteroffer to the UAW, proposing a 16% pay raise for top wage earners. That's been rejected. Here's the quote. GM has come to the table with an insulting proposal that doesn't come close to an equitable agreement for America's auto workers. Katie has the story. Hey, Katie.
Hey, John. Yeah, United Auto Workers President Sean Fain not mincing words when it comes to that GM proposal. He also said to GM, stop wasting our members' time. Now, that GM proposal was actually slightly higher than what Ford had offered the union, and it also included $11,000 in inflation protection payments, but still falling well short of the 46% raise that UAW is aiming for. Now, Bank of America was out with a note this morning on the situation, writing that the fact alone that we've seen counteroffers from GM and Ford suggest that some progress is being made, but of course the parties remain far apart in this scenario. And as such, a UAW strike is, quote, almost guaranteed when the master agreement expires next Thursday. The good news, if you can call it that, John, is that the valuations for GM and Ford, they both already reflect the risks of a material strike. That is according to Bank of America. And if you take a look at the shares, both down double digits over the past 3 months.
That's a big story for next week. Katie, thanks for that. I want to turn to the banks and stay on the labor story. Goldman plans to dismiss underperformers as soon as next month. in another round of job cuts. This according to reporting from the Financial Times in the last 24 hours. Shonali has more. Hey, Shonali.
Hey, John, this too is a story regarding pay, because if the culling happens at the end of the year, as it does at the major investment banks on Wall Street, it makes room to pay the top earners more at the end of the day. And again, the pool has been weak this year with a tough year for investment banking. Now, the Financial Times is also reporting that they are looking to cut at the low end of the typical range of 1 to 5%. That amounts to about 440 jobs. The concerning thing about this year is for the folks who are losing their jobs, there have already been thousands of job cuts, as well as many tens of thousands more when you think about that consolidation over at UBS and Credit Suisse. So a lot of concerns about the excess capacity in this job market and who takes it up. But again, these bankers are also trying to squeeze through a better year next year.
Shonali, thank you. We'll talk more about that next week. Just the labour market, differences there. Some weakness on Wall Street, then the tightness, the labour market pad we've been talking about with the autos and the big three in Detroit. Back with us, I'm pleased to say, Binky Chowdhury, Sarah Hunt. Sarah, thank you for your patience. I really wanted to get to this story with you. The labour market tension for the big three in Detroit. I mentioned this to Mohammed, whether this is the dying embers of a hot labour market or a story that's going to crush margins into next year. Which one is it?
I think it's a combination of the two. I mean, first of all, you've got the issue of deglobalization and the issue of relevance, right? Because you're looking at changing over to possible more EV vehicles. But part of this move on the labor unions, I think, for the United Auto Workers is staying relevant and making sure that whatever changes occur in the economy, they still have a place. I think that there is more, labor does have some more power now than it used to, just because the manufacturing is so much smaller now that the ones who are doing the manufacturing, if they do pull back, that is going to be an issue for those three companies. So they have an incentive, just like the pilots had an incentive and the airlines had an incentive. I think that you're starting to see companies who have been able to charge more for the consumer, their workers are looking back and saying, hey, you guys are making record profits. We would really like a piece of this.
Binky, strong labour market, 1, commodity prices higher, 2. Where does the earnings acceleration come from with that in mind?
So I would say, the earnings acceleration should basically come from top line growth. And at one level, all I'm saying is that what's been going on for the last 3 to 4 quarters, which is, above trend GDP growth, it's not obvious to me that I see a reason, barring some big shock as to why that's suddenly going to change and we're going to fall off a cliff, basically. I would just sort of, this point that I was making earlier, I think is worth keeping in mind, which is basically, at the end of last year, first day of this year, if you looked at the consensus of economists' forecast, what you would see is basically a V-shaped curve, strong growth, coming off very, very sharply. And sure, it was going into negative territory. And so the headline of recession, what we've seen is 2 months later, the V moves, perfectly horizontally to the right. Another 2 months later, we move for the third time. And then finally, we move to the right and we move a little bit up, which generates the headline that the bottom is no longer a recession. But I think the more important point really is that the shape that the consensus has for growth remains exactly the same, which is for a very sharp and very severe slowing that has continued basically to get pushed out. And I think that that's, really the main driver, this big driver of the rally so far. And given where the consensus is, I think the potential for this to go on for some more time, remains basically high. As far as the tightness in labor markets is concerned, my answer to your question would have been neither. I think the labor markets have been tight for 2 years or so. It's not just really in the U.S. And I think, what we have not really seen at the macro level is the corporate response basically to that tight labor market. There hasn't been enough time. And of course, we have the shadow of what we were just talking about, which is, growth is going to fall off a cliff and we're going to go into a recession. And so that's going to sort of slow the response. But if you look back historically at periods of tight labor markets, they've been very important driver by themselves of productivity growth. And so if we don't get this sharp slowing in growth and if we don't get this recession, I think there is a strong possibility that we get much stronger productivity growth. And that, of course, is, very, very positive for the medium-term outlook.
Sarah, that sounds very constructive. Are you on the same page as Binky here, or taking the other side of it?
I'm not sure I'd go fully on the other side, and I think it's kind of funny that we have a both and a neither response, but I think that I have more concerns about whether or not you really are going to see an uptick in earnings the way the consensus is pricing in for next year. I'm also concerned that a lot of the slowdown that we've seen, or we haven't seen so far that we've been waiting for, is starting to chip around the edges. I mean, if you listen to Thorsten Flock this morning, he was talking similarly about the fact that there is some, underneath the surface, you're starting to see some real tension in lower credit consumers and lower credit companies, and some of that interest coverage with higher interest rates is starting to bite. I think that it's hard to say that there is smooth sailing ahead, and I think that the idea that we're not going to get some sort of a slowdown, even if it's not dramatic, is still where the market is priced, equity markets at least, and where consensus is pricing earnings, does look like we're still hoping for some really good news to come through. And I think that I'm a little wary that it's going to be as strong as the expectation is there.
Sarah Hunt, Binky Chowdhury, to the two of you. Thank you. About 13 minutes into this session, this equity market positive by 0.2% on the S&P 500, on the Nasdaq up by 0.4. Coming up, Apple rebounding after shedding nearly $200 billion in market cap in 2 days.
Their supply chain is heavily dependent on China, where they leverage Foxconn, and Foxconn employs more than 1 million Chinese to assemble their products. But they're clearly caught in the middle here between escalating tensions.
Dan Ives, Wedbush, up next.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
China has to, be very careful to what they do with Apple, because China depends on Apple for many things. They are even more important in the upstream of Apple than the downstream of Apple. The direct impact of these bans is very, very, and to be honest, actually invisible.
News Street's Pierre Ferragut expecting Apple to overcome the latest China developments. This after shedding nearly $200 billion in just 2 days as Beijing seeks to broaden its iPhone ban even further to state firms and agencies. All this just days before the iPhone 15 launch event set to take place next week and named Wanderlust, whatever that means. Dan Ives of Wedbush maintains his outperform rating at 230 price target, saying this: in a worst-case scenario, any China government agency iPhone ban is way overblown, citing the ban would affect less than 500,000 iPhones out of roughly 45 million expected to sell in China over the next year. Dan Ives, I'm pleased to say, joins us right now. Dan, wonderful to catch up with you. Tim Cook, as you know, the diplomat, he has really navigated these issues with the US and China so well over the years, and finally he finds himself in the crosshairs. Now, I wonder, Dan, from your perspective, what that means. If it happens to Tim Cook, surely it can happen to anybody.
Yeah, I mean, but in my opinion, this is barks a lot worse than bite. I mean, in terms of all the work we've done, we're talking 500,000 iPhone units and probably less in terms of any sort of ban that we've seen with some of these government agencies, which has really been there for the last few years. And look, I get it. Many people are going to yell fire in a crowded theater, like they've continued to do year over year. We'd be strong buyers here. I think we're going to look back on this as more the opportunity rather than a time to really say structural problems are now ahead for Cupertino.
Context perspective matters, Dan. I understand the numbers like you do. It makes perfect sense. But I think what we're missing here is the signal, the optics. Are we missing a change in mood away from foreign luxury, US hardware, US tech, Apple specifically? Are you missing that shift in mood in China?
Look, at the end of the day, Huawei right now, 2 generations behind. It's essentially the JV phone, right? I mean, no Chinese consumer is going to go out and go for this phone over an iPhone 15, which just continues to be gold standard. Now, look, in terms of the cold tech war between US and China, no doubt that Apple as well as Tesla continues to be caught in the middle. But the tactician Cook continued to navigate this. And also remember, when you look at Foxconn's supply chain, you're essentially talking about the #1 employer in all of China in terms of Apple. So I get the nervousness, but I just continue to believe it's going to continue to be 20% of iPhone. And I think growth is actually going to happen and actually market share in China rather than the opposite thing.
Dan, we are talking about a communist country, though. Why would what China believes is good for its government is any different to what China believes is good for its people?
Because they're basically the biggest employer in China. And if you look within Beijing, especially spend a lot of time in and around China and Asia, it's a trophy case that Apple, that's where their production is. And ultimately, if you look at Cook, despite Vietnam and India and some others, they've continued to really bet the farm in terms of China. That hasn't changed. So this is all a game of poker, and I get some shots across the valley in terms of where Huawei is.
Yeah.
But I just don't see them shooting themselves in the foot. That's our opinion. Continues to be, despite haters continuing to hate on Apple yet again.
And you're perfectly entitled to your opinion, sir. Going into next week ahead of the iPhone 15 launch, Dan, here's the question for you. You always talk about that upgrade cycle, the elusive upgrade cycle. You and I have been talking about that for years now. At what point does that bullish thesis become a bearish one? At what point do you just ask, Dan, why aren't they upgrading?
Yeah, well, I mean, look, if you look at the last year and a half, a lot of those upgrades have happened, but it's almost a high-class problem because they've gained an incremental 125 million users over the last 2 years. 250 million iPhones have not been upgraded in 4+ years. And if you look at this special chip camera technology and what continues to come out of Cupertino is the gold standard. And that's why I believe, especially with a lot of big carrier discounts, this is a mini super cycle, despite a lot of the bears coming out of hibernation mode, after Apple's run.
It's amazing you're talking about super cycles at a time when we've basically got no growth for the core product. Dan, why are we paying up to 30 times earnings for no growth?
Okay, so I continue. First of all, when you factor in FX, it is growing. And then I think it's all about into the next year, where you're going to have mid-single-digit unit growth. You have ASP growth, which is actually double digits, and it's services. I think how many have missed Apple going from hating it at $1 trillion, despising it at $2 trillion, now pulling their hair out at $3 trillion. It's a services business. The sum of the parts we believe is worth 1.4 to 1.5 trillion. And I believe we sit here in the next year and a half, and this is on its way to 4 trillion. This is not the end. It's just the middle of the next cycle.
We won't wait a year to catch up. Dan, it's good to see you. As always, going into next week. Dan Ives of Wedbush, still bullish on this name, as you might expect. Apple bouncing back here by 1.4%. Let's get you some sector price action. Here's Abby.
And it's because of Apple's bounce back that tech is the top sector on the day, John, up about 0.9%. But as you would say, not a lot of drama here. Not surprisingly, with a small gain, we have a few sectors higher. There's actually more sectors lower for the S&P 500, led by the industrials and financials, but down about 0.3%. On the week, though, it's a different story. 10 of the 11 S&P 500 sectors are lower. Energy is the exception, up 1.1%, with oil being higher. But again, a down week for the S&P 500, John.
Abby, thank you. Coming up next, your trading diary going into the weekend and a sneak peek of next week.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
25 minutes into the session, attempting to snap a three-day losing streak on the S&P 500. Positive here by 0.2%. Apple, two-day decline of more than 6%. This morning, at least, a little bit of a lift, a bounce back. Let's see if that sticks. That's the price action. Here's your trading diary going into the weekend. The G20 summit kicking off tomorrow. Sneak peek of next week, Tuesday, Apple unveiling its latest iPhone. Wednesday, US CPI. On Thursday, it's the UAW strike deadline, plus another round of jobless claims and an ECB rate decision. From New York, that does it for me. Thanks for choosing Bloomberg TV. Good luck for the rest of the trading day, and have a wonderful weekend. This was the Countdown to the Open. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. It is Friday. We made it. Coming up, we're going to check in with Dan Ives. He's a senior equity analyst at Wedbush Securities. Get his thoughts on Apple and China and what the risk is there. Plus, Quincy Crosby, Chief Global Strategist with LPL Financial, will give us her market call. Will Rind, CEO at Granite Shares, joins us to talk about single stock ETFs. That's all coming up. But first, let's kick things off with the Bloomberg Business Flash with Amy Mars.
All right, thank you, Paul. Kroger and Albertsons grocery stores have agreed to sell 413 of those stores to C&S Wholesale Grocers. That's a divestiture designed to help win antitrust approval for their more than $24 billion merger. We check the markets all day long at Bloomberg. The Dow little change, now up 19 points at 34,518. S&P 500 up 0.3% or 11 points, now at 4,462. NASDAQ up 0.4% or 52 points at 13,800. The 10-year yield at 4.2%. The 2-year yield at 4.92%. NYMEX crude oil up 0.5% or 50 cents, now trading at $87.34 a barrel. Brent crude up 0.6% or 52 cents, trading at $90.43 a barrel. COMEX gold is at $1,952.40 an ounce. That's a gain of nearly, right now, $10 and climbing. The euro at 1.0732 against the dollar. The British pound at 1.25 and the yen at 1.7.
Traders, how are you today? As you remember, we have purchased euro against United States dollar at 107.24. Right now, I'm going to place a stop loss, it basically on profit, at 107.29. So we'll have 5 pips in other terms, we will get £500 in profit. So this is what we are going to do. Let me, I will draw a line so you will see where we purchased. We purchased at 107.24, and the order I placed to sell at 107.29. Okay, let's see, let's make it more precise. 29, and we'll probably make it yellow color because we didn't yet fill this order. So if it, when it will go down, the order will be filled and we will have profit on this trade. Okay, if it will move higher, for example, as you can see right now, it goes 107.35 and higher, we will move our position to sell with more profit. Okay, guys, stay safe. All of you guys who decided to trade with me, well done. We're already in profit. For a couple of days for us to make £500 only on one contract, it's still quite a good profit. If you want to get the strategy, you need to go to our website and you can purchase this strategy. Okay, I'll speak to you later. Stay safe.
The data is that student loan payments were actually lower in 2022 and early this year than they were in 2020 and 2021. And from that, it kind of looks like some people were still making payments when they had a big stack of excess cash from stimulus and whatever. But as that cash kind of wound down, then they availed themselves of the payment holiday, which means that the shock, the negative income shock from the resumption of payments is going to be more substantial than it would have been a year or two ago. And that's something I think that we all know about just generically, but when you look at the numbers, it could be quite a substantial impact.
First of all, I just want to say, Valerie Titel is a genius.
Yeah, I love the stuff
I she sends love the stuff she sends out, and she is so on.
Now let's explain. She's a Bloomberg.
She's a Bloomberg producer. In London. She often goes on television and on radio, and when she sends her like market vibes column or whatever it is, I always check it out. Secondly, Cameron, there's been a debate about long and variable lags, and I'm interested to know what you think. Some people are saying they're going to be longer now. You know, monetary policy doesn't have as quick a transmission effect, the typical 18 months to 2 years, because everybody's out of arms and into fixed 30-year mortgages. Others, recently, I've heard Jan Hatzius saying he thinks that they're shorter. The lags are shorter now. What do you think?
I think from a household perspective, the lags have been quite short. Yes, the stock of mortgages is obviously tends to be fixed at a low rate, but clearly on a flow basis, mortgage rates have adjusted very, very substantially as the Fed has put rates up, and you can see that obviously through the housing market.
Yeah, but does it matter if mortgage rates adjust quickly since no one's getting a new mortgage?
I mean, to a degree, no. Although insofar as housing sales are a sort of a driver of economic activity in terms of when if you're a first-time home buyer, you have to furnish the home. That sort of activity has dried up. We are seeing a rebound in housing construction, but I'm not sure if that's going to really spur sales activity either, because it doesn't matter if there's an existing home or a new home you're buying. If you have to take out a mortgage rate at the current level, that's not an attractive proposition. Meanwhile,
hello again. As you can see, it moved higher. So I will move our stop loss to 107.34. It will give us £1,000 in profit, 10 pips. So you need to, if you followed me, if you copied this trade, you need to do the same. Move higher, and let's see how far it will go and how much profit we will get by trading euro against United States dollar. I'll speak to you later.
basically anything from banks in terms of bank deposits. Yes, you can move into a money market fund, but if you've just got money in the bank, you're still getting peanuts. So households have seen a sort of a negative interest rate spread develop, and that has been fairly instantaneous. On the flip side, corporations, I think, took out a lot of precautionary debt in 2020 and 2021, and they've been relatively insulated from the interest rate rises. But that then feeds through into when does this debt need to be rolled over and refinanced? You're going to start seeing some of it next year, but that really kicks in 2025. But that's, I think, one of the reasons why the monetary tightening perhaps hasn't had as much impact as one might have thought is because corporations themselves have been relatively immunized from the impact of higher rates because of all the precautionary borrowing that we saw at the height of the pandemic at super low interest rates.
Cameron, one more question. September, you say, is and everyone says kind of at this point, not really a live meeting, but we do get a new dot plot. Does that matter, and do you expect any changes?
Yeah, I think there's a reasonable chance that you see the 2023 dot come down. I mean, most of the FOMC has said, well, maybe we need one, maybe we don't. Clearly, in the last dot plot, we were projecting one more rate hike from where we are now. There is a reasonable chance, I think, that comes lower. The real question will be what happens in 2024, 25. And there, to be honest, I don't have a super strong view because there are rate cuts penciled in, but not super substantial ones. And have we seen anything to really change that outlook? I don't necessarily think we have.
All right, Cameron, thanks so much for joining us. As always, appreciate getting your thoughts. That's Cam Krice. He's a macro strategist with Bloomberg News, giving us his thoughts on these markets. Let's go right to our next guest because we want to talk Apple. The stock is up just about 1% today. It had tumbled over the last couple of days, costing a couple $100 billion in lost market cap since there are some concerns over iPhones in China and all that kind of stuff. So we're going to dig right into it with Dan Ives. He's a managing director, senior equity analyst at Wedbush Securities, joining us via the Zoom thing. Hey, Dan, there is some concern here about Apple and the use of Apple products, Apple phones in China. Can you summarize kind of what the issue is and how material of a risk is it at all to you?
I mean, Paul, in my opinion, bark's a lot worse than a bite. I mean, there's essentially been a pseudo ban of government employees for Apple in terms of iPhones the last 2 years. Now, maybe there was a little more restrictions here, but we're still talking about what we believe is 500,000 iPhones max, relative to what we believe is going to be 45 million sold in China in the next year. So, look, I mean, these black swan types of fears of Apple and China just continue to be the issue year after year. But I just believe here, especially when you look at Huawei phone 2 generations behind, there's no Chinese consumer that, in my opinion, that's, unless they're forced, are buying that over an iPhone.
Still, we saw a huge drop in Apple shares at the beginning of August on iPhone sales slowdown concerns. We kind of ticked back up there, but we're back down near the lows of the year. Not quite there yet. They have a chance to rectify that next week when they come out with new product. Is it going to knock our socks off? Is Paul Sweeney going to go out and buy a new iPhone?
I think Paul Sweeney does buy his new iPhone, in my opinion. Because, look, it keeps coming down to, if you look at the chip, you look at the camera technology, combined with the types of promotions we're going to see from carriers, especially in the U.S., and then you look at 25% of the install base has not upgraded their iPhone in 4+ years. I believe it relates into something where you're going to see actually an uptick in units over iPhone 14. And that's why we're buyers of the stock here, despite haters continuing to hate.
So, Dan, how about pricing? I mean, to be honest with you, I'm probably like a lot of other folks, Dan. I haven't bought an iPhone or upgraded my iPhone in, several years. Talk about the pricing.
You have the 11, right?
Yeah, I have the 11. So
they're coming out with the 15.
So that kind of tells you where it's at. So what kind of pricing power does Apple have in this market, which at least here in the U.S. is, I guess, kind of fully penetrated?
Yeah, I mean, look, we expect for the first time in years, the base prices will be up about $100. When you look at iPhone Pro, as well as on the Pro Max. And this is something where we expect minimal churn because it just keeps coming down to it is the gold standard phone across the world, which is why I believe, I know you talk about Moberg, that I believe at the end of this year, the smartphone leader globally will be Apple. I think they continue to gain more and more share in China. And despite a lot of the noise with Huawei and obviously Cotton's cold tech war, it also comes down to just the best phone out there. And I think they're years ahead.
It annoys me when somebody in my group chat has an Android phone.
Oh, I know.
It's the worst.
Yeah.
Green bubble, and then if they like a comment, it sends like a new text, and...
Yeah, my oldest son is one of those people, and he won't go to iPhone. So, of course, he's excluded from a lot of our, little
exactly.
group things.
Yeah, my dad won't go to iPhone, so we knock him out of the family chats.
Yeah, exactly.
All right, so Dan, Apple, I guess you think is a screaming buy at this level.
I think it's a table pounder, especially what's happened over the last week. And I get it. Bears come out of hibernation mode. Obviously missed a huge run here. This could be it, the quote-unquote black swan moment. We just don't see it. I mean, coming from what we see from a unit perspective, in terms of our trips to Asia over the last, call it 6 to 9 months. So we're buyers here. And I continue to think, as we've talked about, the new tech bull market is here. And I think tech rips into year end.
Hey, Dan, what is, I know Tim Cook was recently over in China trying to work his diplomatic magic here. China, Apple can't escape China, both as a supply chain provider as well as a huge end market. What do you hear from Cupertino as to kind of their longer term strategy about China here? How concerned are they?
Yeah, it's 20% politician, 80% CEO, right, in terms of Cook. And he's been able to navigate China basically as well as anyone out there, obviously along with Musk, in terms of U.S. Stalwarts. Look, when you look at Foxconn, the supply chain, I mean, they're essentially the #1 employer in China from a private perspective in all of the country, right? So they are so important from a production perspective. But it's a game of high-stakes poker. They know they can move things to Vietnam, India. Obviously, that would be painful to do. China obviously is trying to play a poker game as well. But it comes down to the hearts and lungs of the growth story in Cupertino are in China. That's where the share gains have been. And that's why there's so much nervousness over the last week, because this kind of dusts off what's always been that sort of ghost that you're battling when it comes to Apple in China.
I mean, navigating China is pretty easy. You go over there, you kiss the ring, you never say anything bad about China, and you put factories there and employ tens of thousands of people.
That's the strategy, I guess.
I could do it too. The problem is you have to kind of kowtow to Xi. And does that bite them in the butt at all? I mean, it doesn't seem to have hurt their image in the U.S.
Because it comes down to, you're talking about the biggest technology and consumer brand in the world. And if you like $3,000 iPhones, then we should start producing them in New Jersey.
Yeah.
But if you like $1,000 iPhones, they're going to continue being in China. And look, and it just comes down to like that right now, that web in terms of the supply chain, that's been a huge part of Apple's success. But it goes back to like, from the trillion to 3 trillion, many have just screamed that China was going to continue to be the risk for Apple. But ultimately, it's actually been the trophy case, both from a demand perspective as well as it comes to production. That's why, like, Cupertino continues to play chess, others play checkers. And this is no different. They see these chess moves, and I think we'll navigate it. Very contained, despite many yelling fire in a crowded theater.
Hey, Dan, 30 seconds left. Other than Apple, what's your top pick?
I mean, to me, it's Microsoft here because what I view is just the overall cloud and AI opportunity. I think we are now starting to actually see numbers that over the next 6-9 months, this AI tidal wave playing out. And of course, Tesla and EVs, that continues to be the play there. So look, this is, in my opinion, it's a fourth industrial revolution playing out in the left lane of technology innovation.
All right, Dan, thanks so much for joining us. Appreciate it. Good luck to those Penn State Nittany Lions as they play the mighty Blue Hens of Delaware. So it's going to be tough. Dan Ives, Managing Director, Senior Equity Analyst for Wedbush Securities there. he says much ado about nothing, at least at the moment for Apple. And you've seen the stock bounce back a little bit today.
A little bit, trading at 179.62. It had been as high as 196.45.
Still up 30 some odd % year to date, so not too bad. So we'll keep an eye on that. S&P 500 up 0.4%. NASDAQ up 0.6%. So a little bit of a bounce back there for some of the tech-heavy names here. We're gonna have more coming up. This is Bloomberg. Let's get some company news right now. Melissa Mateo.
Thanks, Paul. Goldman Sachs could let go of underperformers as soon as next month. That's according to a report in the Financial Times, which says the cuts would be part of the firm's annual evaluation of staff. Bloomberg Sonali Basak says there's a chance the worst is over.
Well, on one hand, you have them selling off their Marcus loans. You have them starting to get rid of some of the businesses. They're very close to having a Green Sky sale. I'm sure they want to get that off their books by the time they are reporting, if not nearly after. They also have that sale of that United Capital business, which is going to come in at a gain relative to a loss, as we've seen with that Green Sky write-down that they've already taken.
Basak says the silver lining for Goldman is a return of deals if the market holds up. Share of Goldman right now up nearly 1%. And sticking with jobs, the premium pay hikes for those who switched jobs during the pandemic have disappeared.
According to the latest monthly numbers from the Fed Bank of Atlanta, wages for so-called job switchers rose 5.6% over the last year, while those for job stayers rose 5.2%. The difference is the smallest since September 2020, before a tightening labor market sent wages for both groups soaring. The figures add to evidence the labor market is gradually cooling.
And that was Bloomberg's Steve Potus reporting. Kroger and Albertsons will sell 413 stores to C&S wholesale grocers in a bid to close a pending deal. C&S will pay Kroger in all cash consideration.
As you can see, we closed position at 107.34. Well done, all of you who decided to trade, who followed my trades. We made £1,000 just within a couple of days. Okay, and stay with me. We'll never stop. We're looking for another good opportunities to trade. And if you found already, and if you know our strategy, please use it and make more profit. Take more money from the huge market on any exchanges available. Okay, I'll speak to you later. I will try to show on the screen how much profit we made, and stay safe.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:22 on Wall Street. I'm Amy Morris. Stocks have been under pressure this week because of worries that a too warm economy will push the Federal Reserve to keep interest rates higher for longer. We check the markets all day long at Bloomberg. The Dow up 0.2% or 75 points, now at 34,575. S&P 500 up 0.4% or 19 points at 4,470. And NASDAQ up 0.6% or 90 points, now at 13,837. The 10-year yield at 4.21%, the 2-year yield at 4.93%. NYMEX crude oil up 0.4% or 38 cents. That's now trading at $87.27 a barrel. Brent crude up 0.5% or 50 cents, now trading at $90.40 a barrel. COMEX gold at $1,950.60 an ounce. That's a gain of $8. And the euro at 1.0730 against the dollar. The British pound at 1.2497. The yen at 147.51. And just for fun, Bitcoin at 25,908. And that's a Bloomberg Business Flash. Paul and Matt.
All right, Amy Mars, thank you so much. We appreciate that. I want to get right to our next guest and talk about these markets. We do that with Quincy Crosby. She is the Chief Global Strategist for LPL Financial, which is a NASDAQ-traded stock. LPLA is the ticker to load into your Bloomberg terminal. Quincy, thanks so much for joining us here. We've got a little bit of a green day on the markets here today, but I guess a lot of folks are just trying to say, boy, the first, 7-8 months of this year has been pretty darn good, but there's still a lot of uncertainties out there as it relates to the economy, inflation, Federal Reserve, all those types of things. As we stand here in the early part of September, what's your view of these markets right now?
Well, it was pre-announced that we were going to have some bumpy rides in August and September. And then when it happens, everyone starts wondering, well, wait a minute, maybe this is worse than just a bumpy ride. But statistically and historically, when you have such a terrific start to the year, you should have a strong end to the year too. So, as we pull back, obviously we don't want to see a material pullback because that would have folks wondering if this is more than just a normal downdraft. But nonetheless, you could see how Apple came back, and that's important for the psychology of the market, not to mention just the overall price action in the market. And normally the issues that we're worried about tend to dissipate. I mean, one that's on my mind is whether or not the government is going to be able to make payments to keep us from closing down. That should be an issue. And yeah, I see that on the worry chart. It's way down. So again, the market can only deal with so many anxieties at one time, and then it gets bored with the top anxiety. So nonetheless, I think overall, we have to pay attention to that 10-year Treasury yield and keep an eye on whether or not it starts to climb higher, edge higher. That's going to be difficult for the market to absorb.
I mean, Quincy, I feel like this government shutdown thing and worries about a potential default is kind of like the boy who cried wolf at this point. I mean, we know they're going to make a deal, even if they shut down for a week or 4. Do you then buy the dip if you believe that?
Well, yeah, I mean, the same thing as buying the dip during the debt ceiling crisis, right? It just goes on and on. But again, the biggest question, and you'll see it happens every single time we go through this, is we need to cut. We need to cut on one side of the debate, and the others, oh, no, we need to have the nutrition programs. We need to have this program. Ultimately, yeah, they cut a deal, because if they don't, you have the Speaker of the House position jeopardized. He'll be out, and he doesn't want to see that happen. And no one wants to see this kind of dislocation in the government. But you'll hear the comments, are the Social Security checks going to go out? Are the Medicare, is that going to be paid? It's a drama, but yeah, it's a buying opportunity if it happens, yeah. It always is.
Hey, Quincy, you're the global strategist at LPL Financial. How do you think about opportunities outside the U.S.? How do you guys kind of prioritize that?
Well, we do look at it. We had an overweight. We pulled it back just a tad for developed markets. We could see that the Eurozone is under stress, but Japan is doing very well, and Japan continues to do well, and that has helped our positioning with developed markets. That said, when the tech sector is doing well, you can't beat the United States. We have the tech names, and when tech moves higher, the U.S. market moves higher. That said, we're paying very close attention to the strength of the U.S. dollar. Much will depend on, one, what the European Central Bank does, whether or not they come in with 25 basis points. Is it a hawkish rate hike, or is it a dovish? Or do they pause, which looks now most likely not. It is a rules-based central bank. and they want to bring inflation back down to 2%. So what that does, though, is if the inflation numbers next week come in higher than expectations, particularly on the prices paid component, for example, with the PPI, producer price index, what's going to happen is the dollar's strength will continue because the market will price in another rate hike for this year. So again,
I was going to ask about that. I mean, the dot plot is coming out. We're getting the new economic projections, the SEP.
Yeah.
Are you looking for anything special there? Right now we have 4 cuts priced in for 24.
Maybe that gets pulled back a bit, and maybe you start to see just a tad that expectations on the economy is a little bit stronger.
Quincy,
that would be a surprise, wouldn't it?
Yeah, exactly. You know, I'm wondering in the fixed income space, Quincy, I mean, I can buy a 2-year treasury and get, darn near 5%. After the year we all had last year with you couldn't find any security in equities or fixed income, maybe that 5% is not such a bad trade after all. What do you think?
No, of course it isn't. And it's extremely attractive. And look at the money going into that. Any hint that there is a recession coming, which is interesting because then you get the capital appreciation, right? The yields go down. If there's a growth scare, that's when you get paid. But nonetheless, we're looking at investment grade corporates as well, high grade. And then when you go out and look at high yield, those spreads are tight. Either that market is brutally incorrect or it is more prescient than anyone is giving its credit for. We always look to credit to tell us what it thinks is going to happen. And when you look at that high yield market, you wonder, missing something.
Yeah.
Because it's pretty tight. Yeah.
Do you want to short it? Does it make you want to short it, even if you're not going to?
No, even if I wanted to, compliance wouldn't let me say it.
That's what I figured. Hey, what about the industry groups? Because you guys are talking about 5%. Reminded me that my wife is getting 5.3% in her Marcus account.
Nice,
right? That's just
my
like a savings account.
And I matched her. So
and what I mean, this isn't anything to do with our discussion with Quincy, but what my wife does is she gets other people to sign up, and then she gets a few more basis points here, a few more basis points
that's
there.
what my daughter did to me. Okay.
But most financials, Quincy, aren't offering depositors that, and financials haven't performed as well as. Energy and a bunch of other groups. If I look year to date, for example, financials are just unchanged. Communication services up 43%, infotech up 41%, consumer discretionary up 33%. So what do you think about the industry groups? Is it something you like, or something you think it's done too well, something you think not done well enough?
No, we've been in industrials for some time, and that's been doing well. It has been underpinned by infrastructure spending, not just here, but overseas, where American companies are, completely engaged in building cities in the Middle East. And